Mr. Anthony Tzu, Fund Director and Investor of SUSS Fiduciary Services. Mr. Justin Seow, Founder of Acacia Capital Private Limited.
For making time to come down today and supporting this education initiative. So thank you all, and I hope that all of you will enjoy today's event.
Thank you, Leah. Next, we will have an industry sharing by Mr. Teo. Mr. Teo has over 30 years of investment management experience and has served as Group CEO of UOB Asset Management since 2011. He is a CFA charter holder as well. He began his investment career at GIC and joined UOB Career Asset Management in 1994, where he has remained ever since and progressed as a portfolio manager to his current role as Group CEO. Under his leadership, UOB AM established itself as a leading regional player in the asset management industry. Beyond his responsibilities at UOB AM, he has served as treasurer from 2013 to 2019 at the Investment Management Association of Singapore and was a member of the EXCO from 2006 to 2019. In recognition of his contributions to the industry over the last 3 decades, he was awarded Top 25 Leader by Asia Asset Management in 2021 and honored with the Lifetime Achievement Award at AAM Best of the Best Awards 2020. He was also named CEO of the Year in Asia for 2 consecutive years by AAM Best of the Best Awards in 2015 and 2014, and was conferred the IBF Fellow title by the Institute of Banking and Finance in 2015. Mr. Teo is a passionate advocate of digitalization and sustainable investing. Mr. Teo, please.
Thanks, Jonathan, for such a warm introduction. Although I'm supposedly a passionate believer in digitalization, I don't have it on screen here, so I've got to use my paper to go back to the old days. And that's because I can't see very well also. Anyway, good morning, professors of SUSS faculty, Mr. Yamin Chia, Managing Director of Futu, my fellow judges of the Portfolio Management Challenge, distinguished guests and students. Thank you very much for inviting me to be part of the judging panel today. It really gives me a lot of pleasure to be here this morning, and it is indeed a very good honor, a great honor to support such worthy programs. organized by students and the faculty of SUSS. I was told that, by Dion that it has been a very arduous 2 months for many of you for the competing teams before today, which is the finals, obviously. And I congratulate all those who might not be here today for all the hard work you have put in. And obviously to the finalist teams who are presenting today, congratulations. I've seen your submissions and I'm looking forward to your presentations now. And I'm sure all my fellow judges are also. And although every team has their own approach, or what I've seen, I can see the hard work that you have all put in and effort in learning the concepts of portfolio management. So well done to all of you. To the organizing team of SUSS Invest, congratulations for successfully hosting this challenge for the first time actually, and building the structure of the competition from scratch. It is really, to me, a very interesting and innovative education initiative, marrying both theory and practice. And I think importantly, the competition does provide students, all of you here, with a very comprehensive experience of the work of a portfolio manager. Through the case study, I hope that all the participants have realized that portfolio management is not simply about the technical skills, although that's important. The greater part of it is actually empathy, which I'll come to that in a bit. The need to understand and to adapt to your clients' needs and their objectives. So that's the formal part of it. Dion and the organizers also asked me to share some of my experiences and advice to those of you who might aspire to a career in fund management. I guess I've built a fairly successful career in fund management over 3 decades. And looking ahead, we had a tailwind of very strong markets and an increase in awareness of wealth management, of asset management. I think that continues even as we speak today. And if I look ahead, the continued growth of this industry, given by a greater awareness of the importance of financial planning, more investment options now, a new pool of investors, all augmented by advances in technology and digitalization, really means that there are good prospects for all of you who aspire to a career in asset management in Singapore and in Asia. And therefore, there is a good opportunity to build a good career in the industry. But the caveat here also is that it's a very competitive industry. It is to some extent, to a large extent, populated by very smart people. So in investment parlance, there's no free lunch. So how might you stand out then? I think in my experience, there are some attributes that are certainly helpful to provide the foundation for all of you to have a chance to be successful. Beyond the hard skills of a good foundation in the principles of investment management and an objective and analytical mind, which is what I feel are fairly, if you would, hygiene factors. It is pretty much a given in this industry. There are certain attributes, maybe, I won't go through in any detail, but I'll just list them out to you. I think curiosity about the world of business, that's important. To read beyond your textbooks, and if you do enter the industry, to read beyond broker and analyst reports, because those are, to me, a dime a dozen. You need to be curious and explore the perspectives of others beyond what you read and what's manufactured. The second trait is that of humility. It is the humility to know when you're right, when you're wrong, and importantly, to learn your lessons. And it is also to embrace the diversity of views and perspectives, and also to respect the views of others. Because I think all of it come together. I think if you do CFA, you learn about the mosaic theory and stuff like that. But it's all about that. Humility is important. Learn from others. There's one, when I was a CIO, I always told everybody your greatest master in the investment world is really the markets. You think you're a superstar one day and you could be down in the dumps the next. Right? So always learn from the lessons. The third is the ability to operate in ambiguity, and maybe no ambiguities here, because this is an industry that is constantly evolving. not just within the industry, but in response to events around the industry. Obviously, we have the Ukraine war now that has thrown the spotlight in terms of the most considered investment opinions, what they've studied and everything. So I think you must always be open and be able to try, not just operate, but thrive in ambiguity, because that's where you get your edge. The final point in terms of attributes is that of adaptability. It's always to look for better ways to be even better and to be more effective. I think there are certain traits, certain parts of core of investments that will never change. But around the periphery, where you can adapt and become better, just as a very simple example, using technology to make yourself even more effective is really important. Don't always stick to the tried and trusted ways, although that's important. And that should form core principles. There are always better ways to do things better. At UOB-AM, a few years back, in my experience, Jonathan has said I'm quite a passionate advocate of digitalization. We started applying AI/ML to augment, not to replace our investment process, to make our analysts and our portfolio managers more effective. What I suppose simplistically technology can do to help us in an intelligent way, used sensibly, is to screen a wider universe of companies. Because obviously, you know that all of us are humans and we're limited by our time, our bandwidth. The other part that technology can help is in making you more objective. It takes a lot of the emotion out of investing, and in many times that's quite helpful. So my point is adaptability. Be open to new ways of doing things to make yourself even better. But those are, again, was not very hard factors, they're semi-hard factors. In my experience, if there's one word that sort of pulls it all together, and over the long term, what has mattered most is probably this word called passion. If you don't have that over the long term, I don't think I can succeed. What has driven me in this industry in the past 3 decades has been a very deep passion for what I do. I've always been personally very passionate about investing since my university years, like all of you here. So when I was just starting out in investments, I always wondered why I wasn't paid to do a job that I so love to do. I could spend, if I could have no sleeping hours reading the Economist, Financial Times, so I would have done that for free. I was being paid to do a job that I was very passionate about. And as I progressed also, having this passion to continue to grow and to develop both personally and professionally is also important. Don't stand still, in other words. And this couples with a passion to make a difference in people's lives, whether it be those of my colleagues, importantly our investors, and the community and society that we operate in. This has continued to guide me in my role, especially in more senior roles as the CIO and the CEO. And I think this is actually what it means to be in this industry. I don't make it sound, it's not a glamorous industry for sure. It's not just some glamour industry focused on the trappings of money. It is not a get-rich scheme game. But to me, in the long term, it is some place that you can make the difference to others, to your investors, and to the people around you. And I suppose viewed narrowly through an investment lens, it is being able to provide the financial returns to the people who entrust you their money. I think all of you have learned about the word fiduciary. It is something that must stand with all of you. You're managing money for others who entrust you with the money. And so that they can live better lives. And that's all what it really means, actually. So in conclusion, really my personal advice to all of you is to look beyond the hype and glamour of this industry. And really, this is a second word I'll use after passion. Find the deeper purpose in investment management, or indeed whatever career you choose. Yeah. In other words, to round this all up, find your passion, find your purpose. So thank you, and I look forward to the main event today. Thanks.
Thank you, Mr. Teo, for your industry sharing. Before we begin the competition proper, we would like to provide some recommendations to facilitate a seamless presentation experience for all teams. Firstly, please have your mobile phones switched off to silent mode. Secondly, each team will be given 10 minutes to present. The first bell ring will indicate that the teams have 1 minute left for presentation. The second bell ring will mean that time is up and the teams will have to stop presenting, and we will then proceed on to the Q&A segment. Lastly, all teams will be heading to the polling room prior to the competition, and you may proceed to your designated seats and watch the other presentations once you are done with your own presentation. Now, we would like to invite all teams, aside from Team Momentum Capital, to follow our usher and head into the holding area while we set up for the first team. Judges and guests, we'll now have a quick 5 minutes break for the next team to prepare for the presentation. The time now is 1038. Ladies and gentlemen, please back by 104. Thank you.
No problem, no problem. Thanks. Hey Jesse, mask can be on. Mask can be on.
Apparently someone was in terms of you had asked someone, there was a student getting coffee, right?
Sorry?
You a student getting coffee, right?
Not it's one of my. No problem.
Yeah.
They come.
Team Momentum. I'm Ita, and let's over here Timothy and Cynthia. So today we'll be going through our portfolio analysis and thought process using this intense and interesting conversation. So this will be our first table of content. First, we'll be looking at the current profile of view as a whole, followed by the market outlook, like what's going on in the market, how does it going to affect our stock selection, followed by the strategic asset allocation, tactical asset allocation, and our performance that we have contributed during this conversation. So first off, it's our client profile. So you, Mr. Ko, you are 40 years old, you say it's happily married with two beautiful kids, Danny and Hannah. You are a traditional investor and only accept a 5% probability of losing more than 15%. You also like to dabble in ESG stocks and real estate, as you believe that real estate is a good hedge against inflation. Furthermore, your beloved children is going to incur a hole in your pocket as their annual college fee costs around 100K per year for each. Therefore, Momentum Capital is here to help you fix the hole. With a investment 10 million in investment assets, 1% in dividend yield will actually help you to cover one of your children's education. And our children's stock has a total forward dividend of 1.5%. So this means that you get to choose whether Danny or Hannah is your favorite child, and can use that to pay off the tuition fee. So with that, I'll be talking about the global market outlook of what's happening. So first off is the geopolitical risk of the Russia and Ukraine conflict. So the Russian invasion of Ukraine has actually made navigating in the volatile markets even more difficult and caused US equity to be on severe pressure. Second will be actually the Fed hike rates. So the report indicated a faster pace of rate hike throughout 2023, and each meeting is live, and the committee is willing to increase interest rate if inflation surprises on the upside. Last but not least is the global inflation trend. So core CPI remains elevated for consecutive months, and year-on-year inflation goes up to 6%, with an all-time high since 1982. So this actually ties in with the Fed decision to begin a hike cycle in March and a more aggressive tightening soon. So with all these markets outlook, I'll now pass my time on to Sijie to talk about the strategic asset allocation.
Hi, I'm Sijie. Now I'll be sharing with you. Hi, Mr. Ko, good morning. I'll be sharing with you the strategic asset allocation for our portfolio. So this is what our team has shown for overview. The main point I would like to bring up in this slide is that we'll be splitting the portfolio into two parts. For 70% of the portfolio, our team will adopt a macro-driven approach, focusing on top-down stock picking with an emphasis on macro trends. Whereas for the other 30%, our team will be capitalizing and taking advantage of event-driven scenario and periodic macroeconomic concerns to capitalize and try to extract momentum gains. So let me first talk about the 70% of the portfolio. Using Fidelity's business cycle, we first analyze the overperforming and underperforming sectors for each industry versus the US equity market at a given business cycle. After that, we give a scoring system, 5 to the best performing sectors and 1 to the lowest performing sectors. We then weigh the scores of each sector and give them allocate the funds based on the weight. So, knowing you, Mr. Ko, you love real estate stocks. That's why we choose to override the scoring system for real estate stocks and put 22% of the attribution towards real estate. So for this business cycle, we will continuously update it and update our allocation to base it based on the business cycle. We'll continuously try to continuously gain the momentum of strong sectors. Next, this is how we will begin our stock picking methodology. So first, we take the PE, ESG rate, PE and profit margin ratio of each average industry. We believe that this PE and profit margin is the most important factors in this inflationary market condition. After that, we added an ESG factor, knowing that you hate sinful stocks. Based on these three factors, we then start scanning the stocks and select stocks that are only outperforming in terms of these three factors compared to their industry average. We then further filter it by scanning the financials of these companies. After that, we allocate these, after we get the stock for each sector, we allocate them based on their market cap. Being mindful to not execute stocks at an all-time high, we try to only execute stocks when they are 90% of their 52-week high. So next, I'll be passing on to Dash, who will be sharing about the other 30%.
Thank you, Cynthia. Okay, so I'll be taking us through a tactical asset allocation. We have 30% of our portfolio in cash so that we capitalize on any market opportunities that present itself to us without having to change too much of the portfolio weightage from our strategic asset allocation. So this 30% came in handy in late February when the war in Ukraine broke out, because this caused crude oil prices to go up through the roof. And so since we're limited to just S&P 500 stocks,
we use this time to purchase 3 new energy stocks: Diamondback Energy, Devon Energy, and the Williams Company. And also at the same time, the inflation rates in January that came in, the January CPI levels indicated an annual inflation that was never seen before since 1982. So this sent the entire broader markets down, and we felt that the information technology sectors were unfairly hit. So we used this time and capital to purchase stocks which we believe had high growth, at the same time were massively profitable, and we entered into 3 stocks: AMD, Nvidia, and Alphabet. So at the end of our capital allocation, our total equity size increased to 95%. So we still had 5% remaining in cash. Alright, and if we were to put all this together, we'll get a portfolio Sharpe ratio of a 4.8. And the thing is, this is mostly attributable to the fact of our strong and selective criteria which we use for our strategic asset allocation. Because among the 11 sectors that we're in, only 4 came in the red. Those are the financials, consumer discretionary, real estate, and healthcare. And in fact, the 6 stocks which we purchased, 3 from energy and 3 from information technology, all 6 of them turned a profit for us. And the thing is, across the entire portfolio, our success rate was 63%, which means we had a lot more winners than losers. So if we put all this in, this is our portfolio Sharpe ratio, and at the same time period, the S&P's Sharpe ratio was only 0.64. So it means that we were able to beat the S&P 500, whilst at the same time making sure that we meet our clients' goals of having a portfolio with a very good ESG rating as well. And likewise, if we calculate our information ratio, we'll get a ratio of 1.74, and that clearly shows that we were able to beat our S&P 500, the benchmark which we used in this case, and we were able to add value on a per unit of additional risk compared to the S&P for Mr. Cole. So with that, I come to the end, and Timothy will now continue with the performance attribution from here.
Thank you, Dash. Good morning, Mr. Ko. My name is Timothy. So allow me to now bring you through our portfolio risk and attribution. So firstly, the first measure of our portfolio risk was the standard deviation. This was calculated using the daily returns of our portfolio over the holding period, which is approximately 0.88%. This is a low value that reflects low volatility and risk, especially if you compare it to the S&P 500 benchmark, which has a calculated standard deviation of around 2.2% in the same holding period. Next, we then use the value at risk, VAR for short, to measure the extent of possible financial losses from a portfolio within the holding period. As you can see in the slide, the VAR was calculated to be around $86,000 at a 95% confidence level. This suggests there's a 5% possibility of losing $86,000, which corresponds to 8.6% loss of our portfolio in the given period. This value is well within the 15% risk tolerance level as per the client's appetite. Moving on. As for regarding our portfolio attribution, we have chosen what we deem to be the 5 most important ratios for comparison. So as you can see in the slide, our portfolio's annualized return far outperformed that of the S&P 500 benchmark, while only having a slightly higher beta. What this can be interpreted is our portfolio has either higher returns at a similar risk level. Furthermore, our portfolio has a healthier PE ratio, a better ESG risk rating, and a higher weighted profit margin. This is in line with our stock selection methodology, which took into account your preference of investing in companies with ESG awareness. So to sum it all up, our portfolio has managed to overcome our portfolio has managed to outperform the S&P 500 while taking into account your risk appetite as well. So our portfolio has also simultaneously been tailored to suit your other preferences and needs. So Mr. Ko, you can rest assured that this optimal portfolio managed by our team so that help you achieve your financial goals. So in just these 2 short months, we managed to achieve such a track record of our portfolio. We could only imagine what are the possibilities if you were to entrust us with your wealth in the long run. The choice is now yours to make, Mr. Ko. Thank you. Thank you for your presentation of Untitled Chapter. Judges?
I can start off. Just a couple of questions and just to also understand how you're thinking. The first is on risk. The risk that you calculated in terms of standard deviations, etc., is base ex post, is that right? And my point also is that it's also a very short period. What's your thoughts about using such a short period to calculate risk on an ex post basis?
Sure, sir. I'll take this question. The thing is, because we ran this portfolio over 2 month time period, so in order to keep it like fair, so we use 2 month time periods at standard deviation along with the other benchmark index, S&P 500's 2 months to compute them. And the thing is, it's true because these kind of returns, especially this kind of sharp ratio, like returns to risk over a 2 month time period, is not sustainable over the long run. And it's technically not something that will go on for a very long time. But I think just to keep things fair comparison level, because it wouldn't be fair if you were to compare our portfolio's performance for the past 2 months with, say, for example, like the market's standard deviation over the last year or the last 5 years. So we get the concern like the risk here is significantly diminished than what would be over the whole year, because if you were to extend the time period, definitely the standard deviation will increase as well.
I don't know what tools were at your disposal. In the construction stage, for example, did you look backwards or rather forwards that for the existing or ex ante risk that you can help to model the portfolio? Do you all do that? Or it's just these are all derived numbers from the market prices?
Yeah, these are exposed numbers, yes.
So you all didn't use ex ante to model the portfolio in other words.
No, it wasn't extended, yes.
Okay. Second and last question in relation to ESG. Where do you get your ratings from? Is it MSCI numbers or?
Okay, so with regards to our ESG rating, we actually use the numbers from Sustainalytics.
Sustainalytics, is it? Okay. And ESG is a part in constructing the portfolio, or is it a residual after you have made all your decisions and came to the thing that the ESG looks good and that's fine. If not, then you tweak around the edges. My point is, how much was ESG incorporated in the initial construction of the portfolio, or was it afterthought?
All right, so for this question, the ESG ratio was actually one of our main considerations of our portfolio. So we actually consider it as important as other ratios here. So what we did was we first created a model of the S&P 500 stocks. We then narrowed it down to their industry-weighted ESG rate, average ESG scores, and then we then picked the best performing ESG-rated companies from the portfolio to construct our portfolio.
So you, in a way, you pick the best one, or I think it's not fair to say the best ESG rated company within the sector as defined by sustainability. Is that right?
So we have actually picked the companies where they are performing above their industry average in terms of ESG, and this was one of our main considerations of constructing the portfolio.
So maybe if I delve down to the individual companies, would those be in they all have certain exclusions, i.e. they must be low risk by Sustainalytics, or they can be, because these are average costs, right? What does the whole split look like generally? Do you how many moderates? No, I think it's Sustainalytics is very low, moderate, high, very high, something like that. What is the average cost?
Yeah, so actually let me just paint a broader picture. So the ESG factor is actually the main idea that we want to do is actually to generate profits. After all, we are taking out our money, clients' money. So definitely it's a main important factor, but the most important factor that we take into consideration is the PE and the profit margin ratio first for this inflationary market condition. This ESG factor is placed into to help to like cater to the client's needs, as he like to invest in single stocks. So for the ESG factor, we evaluate the average for each industry wise, and we only choose the stocks that are better than outperforming their industry's average, so as to not pick single stocks in a sense because they are better than their industry. So to sum it up, it's just that money is the most important for us first, but then definitely it cater to our clients' needs too. Yes.
To add on to this point, for the ESG scores, we actually look at the rating as well. So Sustainalytics actually have like a range of values where so for this we actually omitted those stocks that actually would have outperformed the industry average, but fell within the risk level of like severe risk or high risk. Yeah, so we only chose stocks that were at most at medium risk.
So you had a minimum criteria for stocks.
Yes, that's right.
And what's that minimum criteria? Moderate or something? I don't know.
Yeah,
Because you just give me an average number here, so I don't know what it is.
right, so the minimum criteria was moderate.
Thanks. Thank you.
Go to slide. You actually have a slide. So go to slide. When you're doing the 52 week, it was your presentation. Yeah, stop there. So one slide down. Yeah. So what do you mean by ESG rating lower than sector average? You mean the ESG risk is lower, right? Yeah, so that will have to reply to your question. Okay, thank you very much for your effort, because clearly I see that you're putting a lot of effort. I don't take too much time, just one general question and then one specific one. The general one is when you look at your SAA allocation, which I think the following slide. Stop. Just one slide down. One slide down. Okay, your pie chart. Yeah, thank you. All right. 70% equity, 30% cash. As it happened, there was an opportunity and you allocated the cash. So my first question is, what happened if there was no opportunity? Were you going to present to us that you were holding 30% cash for 2 months?
The 30% cash was just a discretionary fund type thing, so that if we were to spot an opportunity to get in. So the thing is, because we didn't want to be all in the market at all times, so it's highly likely that we would have kept 30%. But the thing is, it's also quite unlikely that no events would happen over the 2 months. So it was just like a buffer that we needed so that we can capture short-term market trends and ride the uptrend. Yeah.
So Mr. Cole, right? I gave you $1 and you're telling me that actually you just needed 70 cents. That's basically what I'm telling you. Right, so that means I could have kept my 30 cents and maybe 70 cents. We could have kept it as an alternative, whatever it was, but generally we wouldn't have taken that risk. And as it happened, you were fortunate that mid-2 February there was an opportunity that you could allocate it. So that's my general question. The specific one, actually if you go to the 2 slides down, down again, yeah, down again. All right. So, if you imagine you have friends who perhaps like to be real estate or perhaps want to be architects, there's a reason that they didn't go to business school like you guys. So, if you were talking to your friends and explaining to your friends how you will invest their savings for the children, what is the level of numbers or conversations that you think would be appropriate for them? For example, let's go to the next slide. Open the short ratio, for example. Okay, so I'm an architect. Explain to me why this matters to me.
Oh, okay. So I think to explain, first is architecture, I think it's very not a very basic financial knowledge. So I think how I explain to you, I think it's like if you invest $100 in S&P, end of the day, out of 1 year you get 110. But actually, if you were to manage your portfolio, you will be able to be better than 110. We achieve like 148 using our methodology. So I think that's how we will break down into simple numbers like a day-to-day conversation.
Now I'll give you the answer actually. We are very much better, or we are the best percentile performing portfolio than any other person. That will kind of explain. Right, short ratio of 5. If that is true, congratulations, fantastic. But that should be how you explain the architect.
Okay, got it. Thank you. We have one last question. If you have further time,
I'm just going to say nice things to them.
thank you. We've got time for that.
Yeah, I think it's very interesting, your presentation. I think a couple of factors. One, so you try to create a dividend yield, right? I think that's very important in financial planning. I think my colleague, fellow judge, mentioned about whether you are fortuitous or fortunate to have 30% cash. I always believe in keeping cash allocation as well. Over a short period, it's quite difficult to know whether you're lucky to put that to work, but let's assume it's smart enough to do it. And then, of course, you did the right thing to put it into IT sector, and like my colleague said, I think you underpaid, your high return through the Sharp ratio, etc. My only question is that you had kind of followed pretty much Mr. Ho's requirement for real estate, therefore we're heading back to the real estate. So I don't know, maybe you could explain to me just very quickly how much of the real estate exposure is quite high, 50%, has impacted your performance as well as your ESG rating.
We had like 22% of our portfolio in real estate, and unfortunately, real estate was one of the biggest statements. So the entire sector was in the red. And if I'm not wrong, like one of the saving grace for the real estate sector is that it contributed one of the highest dividend yields. So if you were to put it over a long-term period, like over a whole year, in fact, the dividend yields from our portfolio just in the real estate sector is more than 2%, about 2.66%. So we would recommend to our client, like if he's really interested in real estate, even though like on a capital gains basis wise, like stock price may drop, but the thing is he will still be able to get a dividend yield, which can help to help to elevate the overall dividend yield, which you can use to pay for his education as well. So perhaps we will tell him this, whilst at the same time telling him that there's also a risk of over hedging because he wanted to get into the real estate market to hedge inflation. But the thing is, if he's too involved, if his preference for real estate is too high, he might be running the risk of over hedging. Yeah, where it wouldn't like the whole portfolio will be balanced. Yeah, and if you have time.
Yeah, I just have one other question. Yeah, thanks for putting this together. When you put in the different filters, the PE, profit margin, etc., right? What is the time period which you're looking at these filters? Is it like last 12 months, next 12 months, average the last 2 years? Like, or then the next question is, why should you pick that period to do these filters?
So, firstly, regarding how we pick the PE and the profit margin ratio, we take a trailing 12 months rate. So, because the trailing 12 months, we didn't take a higher year than that because we believe that the short term reflects like a stronger picture of, especially for 2 months competition. So, this short term will reflect a higher picture. So, this is strictly based on this competition itself. So, for this competition, that's why we take the 12 months. But if we were to invest in long term, we will actually take the 5 years ratio instead because it's more reflective of the long run. Yeah, so I hope this answers the question.
Great job, guys. Maybe I just got one question because I was running through the slides around 16, and you are one of the two things that never really put in on the macro side on the COVID, situation. So, things are, in certain countries there's all the different policies, etc. So, whether inflations or even Fed hikes, I think there's indirect impact, with the recovery of all this, pandemic. So, just want to hear from you how what is it out and why is it not integrated inside? Yeah.
Sure, because like we were thinking on a forward basis, and COVID is already like an endemic type situation now. So which is why like we left out most of it. In fact, right now, according to the business cycle, we're heading towards the late business cycle. So we are already like past the COVID stage. I feel like we are in fact like on the verge of like getting into the recession fears and all that. So that's like a bigger concern now. And also like in this period of time, we are focusing more on like forward returns and like the recovery from COVID rather than the fallback from COVID. Yeah, because of the high inflation that all the aids that was given during COVID, right? So we are now facing like the after effects of that instead of like going through that process right now. Yeah.
Okay.
Thanks so much. Thank you so much.
Great, judges, we have now ended the Q&A segment, so please have the next 5 minutes to deliberate on the performance of Momentum Capital.
Unless you want to create a module. Oh, sure.
Because the sex budget, you budget to make how many you really want to yeah. So maybe you can but they didn't you think about it. You think about it, how do you try to go at the other thing? Also, because your picture definitely will be more content. Yeah. Yeah. I think I'm not sure, but yeah, they are comfortable. They don't. Yeah, all the people that mean at home
Team 2, once you're ready, please begin.
Good morning, Mr. Ko. We are Rawr Capital and nice to meet you again. Today, we'll be walking you through your portfolio performance and showing you how our benchmark plus solution best meets your investment needs. To get us started, sorry.
How do I increase the
Sorry.
Do you want to restart the time?
thanks?
Sorry. Good morning, Mr. Ko. We are Rawr Capital and nice to meet you again. Today, we would like to walk you through your portfolio performance and show you how our benchmark plus solution best meets your investment needs. To get started, we understand that you're planning to retire in about 5 years and that you hope to invest in the markets so as to meet your retirement goals. Based on your risk objectives, we understand that you have a moderate risk profile due to a medium risk ability and risk tolerance. For your risk ability, we have taken into account that you will be financing for the education of your 2 children. And for your risk tolerance, we have considered the fact that you have an education, and you have considered your educational background as well as your comfort level with an investment drawdown. Thus, with your risk and return objectives in mind, we propose a balanced portfolio consisting of 60% equity, 38% bonds, and 2% cash. This will help you to remain diversified and minimize risk while maximizing returns. For this trial period, we'll be focusing on the S&P 500. However, if you choose to take it forward with us, we can introduce a more holistic portfolio. We've included some key investment themes as well as macro trends for your reading pleasure in slide 3 to 5. We can address any questions that you may have in the Q&A session later. However, let us focus on the US markets for now. Despite recent market volatility, we believe that the US remains a bright spot. While the Fed's hawkish tone as well as reduced fiscal spending has posed as short-term headwinds, we think that the US has more room for growth on the back of solid earnings as well as consumer spending. We would like to highlight 3 key themes for the US markets. Firstly, the Russia-Ukraine war that is expected to increase market volatility as well as inflation risks, especially in terms of higher commodity prices. However, we think that the US remains largely insulated from this due to reduced trade exposure with Russia. Secondly, we think that the series of rate hikes will be expected to increase equity market volatility. And thirdly, we think that there will be persistent inflation risks due to pandemic-related supply chain disruptions. These 3 key themes set the stage for our investment decisions in the US.
In accordance with your instructions to only invest in S&P 500 large-cap equities, we have identified selected investment opportunities by sector as defined by the global industry classification standard. Sector preferences are important as they inform the adjustments of the allocations in the portfolio based on this benchmark. Let's first review the sectors that we are overweighted on. Recovering oil demand on the back of economic recovery has been supportive of the energy sector. Sanctions imposed on Russia will further drive energy prices up. Meanwhile, valuations in the financial sector are relatively attractive, with rising rates expected to boost earnings. Consumer staples is a defensive sector, and firms with stronger pricing power can potentially benefit from high inflation by rising prices without losing their customer base. Meanwhile, COVID-19 has accelerated innovation pipelines across many firms. Several trends such as increasing global life expectancy will support the sector in the long run. Moving on to the sectors that we are neutral on, rising fuel prices and workforce shortages will pose headwinds for the industrial sector. Similarly, labor shortages and supply chain bottlenecks will challenge the material sector. While larger cost of debt will also pose a headwind for the utility sector, which requires large ongoing capital spending. Although we understand, Mr. Koh, that you think that real estate is a good hedge against an inflationary environment, and we certainly agree so as well. However, we think that this sector is also highly leveraged and therefore sensitive to rising rates. Therefore, we've only slightly increased the proportion of allocation to real estate names in your portfolio. This is the benchmark. Finally, let's take a look at the sectors that are underrated. Valuations in the tech space are currently extremely stretched, following a strong rally in 2021. Therefore, this sector is extremely sensitive to interest rate rises. In the communication services sector, a return to life pre-COVID may threaten demand prospects. Although improving economic conditions will increase spending in the consumer discretionary sector, we think that major industries within the sector, such as EVs and e-commerce, are highly overvalued to invest into the sector. Here is a summary of our sector preferences. All in all, holding a mix of defensive, inflation-sensitive, and interest rate-sensitive sectors will help to pull your portfolio through a volatile mid-cycle market environment characterized by high inflation and interest rates. We also reduce your exposure to long-duration sectors, whereby valuations will be impacted by rising rates, and through cyclical sectors where it's more difficult for offer to pass on rising input costs to consumers.
Your portfolio is a product of a collaboration between you and us. We first started off by considering your investment needs, return objectives, and then risk profile. Then we went on to consider the macroeconomic environment at the current stage of the business cycle to determine our sector preferences. If you choose to work with us beyond this, we'll include unstoppable teams besides like 5 at this stage, which will drive the next era of investing. After determining our portfolio rates, we use rigorous stock screening and selection process. This is an in-depth quality assessment that uses fundamental analysis. Additionally, use exclusion and thematic analysis to align your portfolio with your ESG considerations. From there, we can pick 3 to 6 stocks for each sector as a high odds of outperformance. One of the chosen stocks that we have is Coterra Energy, which has a high operating cash flow, EPS, and a P ratio of around 10. It is considered to be highly undervalued when compared to other energy companies with a P ratio of above 20. Coterra Energy eventually went on to become the best performing stock of your portfolio, generating a total return of 30%. So from our top-down approach, we are able to construct a high-quality portfolio that is customized to your needs. We call this the benchmark class solution, where we are aimed to outperform the S&P 500 on minimizing investment costs and managing risk within your tolerance level. Mr. Cole, we understand that you are a busy man and it's challenging to always keep an eye on the market. Hence, our team rebalances your portfolio on a monthly basis to adapt towards macroeconomic events. We also review the stocks of your portfolio to read up poor performance and shift allocation towards expected strong performance. Additionally, we also optimize your portfolio using a mean variance analysis to maximize your returns and minimize your risk. At the end of February, we made 3 key decisions in rebalancing your portfolio. We decided to increase our overweights on the energy sector because of the ongoing Russia-Ukraine war, which has pushed energy prices even further. We also increased our weights on the financial sectors, as we expect more aggressive rate hikes throughout the year. In contrast, we further reduced our position in the industrial sectors due to rising fuel prices and worsening global supply side constraints.
We also like to highlight 3 important portfolio characteristics. Firstly, the portfolio has a lower analyzed standard deviation than the benchmark, indicating less risk. Secondly, even though your portfolio has an information ratio that's negative, it has a Sharpe ratio that still indicates outperformance against the US 10-year treasuries on a risk-adjusted basis. Lastly, as per your requirements, your portfolio has achieved a VIR of less than 50% and a low-risk ESG rating. Additionally, for your perusal, we have included your portfolio's top 7 positions, as well as broken down your portfolio's returns into the allocation, interaction, and selection effects using the Brinson model. On this slide, we have also included your portfolio's top and worst performance. All in all, we believe that our portfolio has been able to meet your risk and return objectives, as well as your investing preferences. Furthermore, your portfolio has also outperformed in terms of the allocation effect, but underperformed in terms of the stock selection effect. The portfolio also has a higher dividend yield than the S&P 500 and has a slight value factor tilt as well. Lastly, we have also remained cognizant of key risk factors that might affect your portfolio, as well as coming up with corresponding solutions that we can discuss. All in all, it has been a pleasure to have worked with you over the past 2 to 3 months, and we hope that we can continue this relationship and showcase our systematic portfolio management approach, where we understand your requirements, combine it with our macroeconomic analysis and stock picking skills, so as to refine your benchmark class solution, where we aim to outperform the S&P 500 while minimizing your investment costs and risks. Thank you. I would like to open up the floor now to any questions.
Proceed with the 14-minute Q&A segment. Judges, please note that there will be a bell ring at the 13-minute mark, and then another bell ring at the 14-minute mark to signify the end of the Q&A segment.
Well, firstly, thank you for putting together such a thorough presentation. I know it's a lot of effort, it's a lot of information. For me, it's not too much of Q&A, just more feedback. I personally think that you did a lot of work, but this is a bit too technical, too complicated for somebody like this to cover. Like, to be honest with you, for me, I'm like, oh, it's a lot of information to digest, and I spend a lot of time having to read and have to focus on you. So maybe just think about your target audience. I think we've raised this question this point before. I think the other thing was I think the first page, I think you had the word like inexperienced investor. So if I'm talking to a client, I probably use that word in the presentation, maybe like non-professional or like full-time investor. Because if I read it, I know I'm inexperienced, but to actually see that. So there's some things I picked up, but we overall did get a lot of work, so I really appreciate it. I'll take some more time to digest it.
Thank you so much for feedback.
Yeah, thanks very much for the presentation, very interesting. What I really like about the presentation is that you made the attempt to be very transparent, right? So you attempted to explain your real estate allocation to your client, be it, even he has a affinity for it, but if you can't, then you have to explain why you think, you may technically decide to, go against it. I like the fact that you do conviction investment because it's what I do, so it's my slide bias. And then I think there should be a better visualization when you change portfolios because I don't think you can see it very clearly. But anyway, I think your transparency, or then to be transparent, I led to one contribution, but not only to bring up the slide on performance attribution. I think you mentioned that the performance from bottom up wasn't very good, and more of the performance was from portfolios from sector allocation. But then you're doing convection investing, which is actually your bottom up. So you're supposed to do that. So if I were applying, that leads me to wondering what is skill set. So you're very transparent, thank you for that, but it kind of contradicts. But the skill set is only a judgment, but the performance is suggesting otherwise. I don't know whether you have.
Thank you for your feedback. Actually, for us, we try to take a longer term view in terms of the stocks that we picked. So yes, they may have a slight drawdown in the past, let's say 2 to 3 months. But we believe that over the longer term, these stocks will probably outperform over a longer time horizon. Yeah, for me, great job done. First of all, I think the reason why I mean, to me, yes, I will use the word very transparent. I mean, very clear, and that's also the reason why when I look at the first slide, you all did point out that it's actually an inexperienced investor. So that is also transparency. So so for me myself, generally I think a bit more visuals. I mean, in terms of diagrams, if not, I would say it's a great job done.
So the first thing I have to ask is regarding this slide. Can I confirm 60% bonds? So when we talk about everything else after this slide, we're just thinking about the 38% equity slides, right? We did not the bond or all your numbers inclusive of the bond drag that you have.
Sorry, just to clarify, our asset allocation is for balance portfolio is 60% equity, and 40%, 38% bonds. Yeah, and then for the trial period, because Mr. Cole only gives us like 1 million to see our performance for the S&P 500, so we just constrained it to the S&P space for the time being. But we are proposing that we will move forward with a more holistic portfolio for his.
Yeah, so the numbers that we present are actually for the equity.
Yes, this is for the equities.
And then also just bear in mind, if my requirement is not only in S&P equities, do bonds count inside S&P equities?
No.
Second thing I want to remark is a common feeling that the judges. It's very difficult to explain all this information within the span of 10 minutes, and it's important that you all identify the key point which you did have to explain the problem back to the client. So that was a good job. Thank you.
Thanks. Again, echoing what the judges say, a lot of effort put in, but ultimately probably too much information. And I think we spoke about empathy for clients, and I think this is really technical. I suppose if it became true me in my company, I'll put a lot of the information in the what we call appendix, really. So that's just a general feedback. Don't be too wordy. Focus on key points and make that impactful. The second broad comment I have, and this is not just for this withdrawal, but also the previous one, is whether you can be more creative around the way you align with the client's preferences. I'll give you an example. In fact, two examples. He has a preference for ESG, right? Most people, and I'm speaking here from my experience speaking to clients, the base is obviously the ratings, but I think that will not be enough for you to, you'll be pretty much run of the mill. What I'm suggesting also as a way to think and to again align with clients is that maybe, for example, you can find certain, beyond just average ratings, find certain sectors, certain companies that are really being focused, right? So you give that a slight tilt. I mean, it has to pass all your investment criteria, etc. Right? So I think that qualitative part is something that you can sort of make it more interesting for the clients. On the real estate, again, it's a general statement. I know rates go up, real estate should suffer, but again, the entire real estate space is a very diverse one. There's industrials, there's hospitality, there's retail. And I think if you want to resonate with the client, you've got to show that depth of understanding. And even convince yourself, it can never be one size fits all. Real rates go up and therefore to buy real estate. There are always segments and even companies that can thrive in this kind of environment. And it could be both from a top down and also a bottom up point of view. Bottom up, some of them are very deeply discounted. Maybe there's value there. So I think that part can give you the edge in presenting and probably winning a client's mandate. Otherwise, you're going to be just like everybody else. Average ESG ratings, rates go up, don't buy too much real estate. But he's telling you he wants these things. So you've got to show some kind of value add to it. That's my feedback too. Not just for this group, but in general. Yeah.
On the controls regarding the real estate kind of things, right? One of the main that we actually selected was sectoral real estate. So the reason why we chose that was really from a more sector perspective, because we thought that as a real estate would be a play on healthcare, which we are also overrated on. Because what they do is that they actually rent out a lot of space with urban innovation clusters, with support urban farmer firms in terms of their net space, etc. And we thought that the business model is also pretty good because firstly it is a niche area, so it is quite well connected in terms of their cash flows, and I think 85% of their cash flows actually come from 20 major businesses that have very reliable cash flows. So because we like that, so that was one of the names that we actually included in the portfolio. But I think we have the time to flesh it out in that.
But you see, we got 10 minutes with class, we got to flesh out what's important and what's not important.
We got one more question from Miss Holly, who's currently online. So she's also one of the judges that is judging the competition. So she asked, can you share how you will show that there is sufficient income for college education, which was your objective?
So in terms of the college income, I believe it's 100K per head over the course of 4 years. So we assume that the student is in the college, so 25K per head. Then assuming that both children are in college during the same period, that's about 50K or about 5% returns. So currently our portfolio returns are slightly more than 13%. So we feel that even though we can't guarantee that consistent return because there's no such thing as guaranteed returns, but there is actually buffer in terms of being able to meet that required 5% return based on just the equity portion. I think even if we put a bond portion in the future, even with the contract, we don't think that the percentage will actually go down by so much as to go below the 5% as well. So I hope that answers the question.
Can I ask one more? Can you go to page 14 of 16 of the sheet? Yeah, so for this, yeah, page 14, yeah, so I think it's a very interesting page, and is there a way, assuming again Mr. Cole is not very sophisticated person, like what does this page really mean? Like what is allocation effect, interaction, selection? Then the next question is, I see that you have overweight, underweight, neutral, etc. And then I see things like IT is underweight, we have 14.87%. And then consumer services underweight, you have 5.28%. So like, what is like, why are you putting such heavy weight on something that's supposed to be underweight? Like, so I think over this, like for me, if somebody's not sophisticated, if I'm looking at it, like, I love the bottom left chart because I feel like I've heard of these companies before. So at least I know my money's going to these companies. Everything else, I feel like, what does it really mean to me? So if you can explain like in terms of
Alright, I guess I could simply explain what does the Princeton model actually do. So basically it breaks down your portfolio returns into three different effects. Firstly, the allocation effect, which determines how well we allocate to every sector. Secondly, we have the interaction effect, that is kind of the cross product between the allocation effect and the selection effect. So then lastly, we have the selection effect, which is basically how well our stock picking is. So to answer your question, I guess how we could perhaps improve on this slide is in terms of highlighting the, I guess, overall effect. So instead of having so many numbers, I think visualizing it in a, I guess, a bar chart or something would be much better. Or perhaps just highlighting the overweight or underweights separately.
And how about the second question on underweighting, that you have very, it seems like the portfolio weight is pretty high sectors.
Oh, yes. So for that, we tend to rely on our macroeconomic analysis first. So from there, we take more active positions in terms of which sectors we are heavily overweight or underweight on. So that large allocation actually comes from our macroeconomic analysis. So we decided to implement our view from a top-down perspective first, where we choose a target weight for every sector that we want to allocate into and decide the underlying stocks after that. I think that answers the question.
Judges, do you have any further questions? Okay, if there are no further questions, we have come to the end of the Q&A segment. Thank you once again, Rawr, for your Judges, let's have the next 5 minutes to deliberate on the performance of Rawr Capital.
No, but the participant is
That's why the numbers are.
Hello. Can you hear us?
Yes.
Yes. Hi.
Okay. Yeah. So we will be sharing screen.
So you're the MingLee team. You're presenting online.
Yep.
Ah, okay.
Yeah. Because unfortunately today we have two COVID cases among like our team members. So yeah.
Okay, so I get the special audience then. Hello.
Right. So the organizers, so let us know when we can start.
Okay. Good morning, panelists. We're Rawr Capital, and today will be presenting on our strategy to instill confidence to invest in an uncertain and new economic regime. So here's our agenda for the presentation. So given several key financial considerations and distribution requirements of Mr. Koh, we set out to determine an asset allocation that could meet his risk appetite and distribution requirements. So to help our understanding of a broad and complicated S&P market index, we broke it down into 11 different subsectors. So on the next slide, on the left, we have the current S&P 500 market cap rating of the 11 different sectors, and these ratings reflect the historical and astronomical growth that we've seen in 2021, and we believe that this will not be able to achieve deliver superior risk-adjusted returns in a new economic regime. So in light of this, we propose an inclination towards more value sectors and away from growth. We summarize our view for 2022 using relative weights allocated to each S&P 500 sector on the next slide. Along here, we will be presenting 4 essential principles that we will abide by.
Sorry, Brian.
Yeah.
Can you restart?
Hi, may I start now?
Yeah, please go ahead.
Okay, thank you. Good morning, panelists. We are Rawr Capital, and today we'll be presenting on our strategy to instill confidence to invest in an uncertain and new economic regime. So given several key financial considerations and distribution requirements from Mr. Koh, we set out to determine an asset allocation that could meet his risk appetite and distribution requirements. So to help with our understanding of the broad and complicated S&P 500 market index, we broke the index down into 11 different subsectors. So on the next slide, on the left, we have the current market cap rating of the 11 different sectors. And these ratings currently reflect the historical and astronomical growth that we've seen in 2021. However, we believe that this current weighting will not be able to deliver superior risk-adjusted returns in a new economic regime. So in light of this, we propose an inclination towards more value sectors and away from growth sectors. Now, next slide. We summarize our view for 2022 using relative weights allocated to each of these sectors, along with 4 essential principles that we abide by in our strategic asset allocation. So firstly, we think that earnings guidances and revisions will be more of a common sight in the year ahead given the economic volatility. And these constant revisions will likely pose lower gains for US equities in general. Secondly, against a backdrop of tight supply chain issues, this will continue to pose a key risk for US equity markets, and this will continue to fuel cost-push inflationary pressures further. Thirdly, with inflation becoming non-transitory and also the US economy posting stronger employment figures, rate hikes are likely to be revised higher and even perhaps more frequently. So lastly, we also want to take into consideration the potential for a commodity super cycle as global energy trade remains disrupted by the current unfortunate Ukraine crisis. So in the interest of time, let us highlight our view for some of these sectors. So first, let's look at the material subsector. High domestic manufacturing activity is expected in 2022 to produce the key strategic inputs needed for the US's next phase of development, which focuses on connectivity. So the US Infrastructure Investments and Jobs Act will support the material sector as we expect an increased demand for precious metals like lithium and cobalt. So moving on to the bottom left, onto the consumer discretionary sector, the reduction of unemployment benefits will reduce the personal disposable income by $60 billion for the bottom 40th percentile of the US economy. So coupled with a high inflation environment, we remain cautious for the consumer discretionary sector. On the next slide, we are constructive of the industrial sector given its numerous airline names. So we observe that domestic travel continues to remain strong in 2021, given that the revenue per kilometer traveled for domestic flights recovered near pre-pandemic levels in late 2021. However, on the other hand, we remain cautious of the technology sector despite its potential, because we feel that the limited semiconductor supply contracts remain fully bought up until 2023, and that this sector also remains highly concentrated with very few names. So now we'll be moving on to our tactical asset allocation.
So towards the mid-end of February, big changes were happening in the world. So of course, we have the Russian-Ukraine war, and as well as there's an unexpected and greater tightening of monetary policy in the US, explained by Brian just now. So we have decided to make the adjustments from our SAA to TAA as shown from the left to the right. The greatest changes that you will note are that we are investing more into energy, materials, and utilities, and less in information technology. So the goal is to increase our short-term gains from energy, materials, and utility sectors with these big world events happening. So by increasing exposure to high quality companies from the mentioned sectors, we'll be in the position to gain more short-term gains, and at the same time, we'll be reducing our exposure to the at-risk sectors. So we propose to overweight in energy and materials against high inflation. Energy sector being a primary victim of the Russia and Ukraine war, with Russia being a key exporter for oil and natural gases to Europe. Materials, on the other hand, which are primarily metals and mining, allow for increased exposure to commodities in a high inflation environment. Both sectors currently have lower price to book ratios than S&P 500, which generally means that it's at a good value and is good, allowing us to enter at a cheaper price and increase exposure to higher value sectors, but also increasing protection against cost push inflation. On the other hand, energy, with skyrocketing oil prices in recent weeks, is likely to lead to a fear of demand destruction. However, we feel that this is unlikely to happen as there are few to little alternatives available at a commercial level to replace oil. Furthermore, oil prices today are still lower when compared to 15 years ago. Thus, demand destruction is unlikely to occur. We focus on multi-utilities with energy production, not limited to oil, but many other renewable sources of energy, such as wind and solar as well. These companies are more resilient against rising oil prices due to significantly less increase in cost compared to other companies which rely heavily on oil. This not only increases protection against inflation of oil prices, but also improves the overall ESG ratings of our portfolio. Next, let's look at two stocks from the energy and utilities that we decided to focus on. For NextEra Energy, we felt that it has a large and diverse portfolio of energy generation assets, and also uses many forms of renewables for energy production. It has also been outperforming the utility sector and has high revenue growth. We've also chosen to look at Devon Energy, which has been performing well in revenue with high free cash flow, allowing them to better pay off debt, contribute to their growth, and also to pay dividends. In 2021, they gave a record high dividend of $1 per stock, which is considered a very high dividend amount for S&P 500 stocks. Thus, we are not only looking for returns from the stock gains as well, but also returns from dividends. Next, we'll move on to our portfolio.
All right, so some of the key takeaways from these numbers that you can see on screen is that while our portfolio returns are slightly lower than S&P 500, our portfolio managed to reduce our risk compared to S&P 500 by improving the VAR by plus 0.66%. We managed to achieve this while maintaining an acceptable level of ESG rating. And one of our objectives is to maintain long positions without the frequent need for rebalancing and avoid a high transaction volume. This is because we believe in our investments, theses, and our positions as well in the long run, and would like to avoid trading, swing trading and its associated risk. So next slide. So this is our portfolio attribution. So from this, we observe that our strategy is to overweight energy and materials, and this is paying off as it helps to achieve superior results. Investments in materials and healthcare were also strong in our portfolio. So another choice that we made that is quite good is underweight of IT and financials, which is the right choice as well. So it is important that this merely shows the numbers and it does not show any other goals such as reducing risk and ESG, etc. So next slide. So this is the sector correlations between each sectors. So for energy sectors and utility sectors, they are generally not as correlated to other sectors compared to like ITs and financials. So this acts as a diversification mechanism for us as it helps us perform better than the S&P 500, especially when it's in such volatile times. All right, next slide. Yeah, next slide. Yep. So these are like 4 key strategies for us when it comes to risk mitigation. So firstly, we would like to establish for a maximum stop loss plan. And secondly, we also tactically allocate our assets according to the market scenarios. On top of that, we also try to avoid a high volatile portfolio, especially in such times because of the ongoing crisis. Moreover, we also want to maintain an adequate amount of liquidity because it allows us to take advantage of the upcoming opportunities and also allow us to rebalance our portfolio if necessary. So we also took into account of our clients' needs for withdrawal. Therefore, we hold like a certain amount of liquidity in our portfolio. Next. So now moving on to sustainability portion. So our portfolio shares similar values and sustainability, and is consistent with the future of our investments. So this sentiment is also shared by the UN Principles for Responsible Investment, and this is also driven by a shift in demand for sustainable investing and is driving such efforts forward. So next slide. So for our portfolio, we focus on a responsible approach towards sustainable investing, and our priority is to seek a competitive risk-adjusted financial returns while avoiding harm. So this is achieved by having an ESG factor integration, where we screen investments for the ESG goals and their ratings as well. So some of the pros of ESG investing is that these firms are typically long-term, they seek long-term objectives, and which makes them forward-thinking and reinforces the risk management. However, some cons include, taking some short-term risks with investments, which might not pay off in the future. So next slide. So, however, we are very pleased to say that this does not mean that we are sacrificing performance for ESG goals. This can be observed by the fact that sustainability-focused funds demonstrates potential to generate better returns than the underlying benchmarks. Yeah, so with that, next slide. We thank you for your attention and we are open for questions.
Thank you for your Q&A segment.
Thanks for your presentation, MingLee. Just a few comments and questions. Maybe I'll start with the questions first. What is strategic asset allocation in your context? Is it the index or when you make tweaks to your index? And if you do make tweaks to the index for SAA, then what is TAA? Yeah, that's a question.
So I'm not sure if I caught your question correctly, but I'll just try to answer first. So, okay. I think you might need to look in case there's a... Yeah, okay, so I'll start explaining how, because it's for us to we felt that our approach to try to outperform the S&P 500 index is difficult if we do not have like certain benchmarks to follow. So first of all, we subcategorize the S&P 500 index into 11 different subsectors like healthcare, real estate, and industrial, so that we can focus specifically on like these different sectors. Yeah. So then subsequently from there, how we view our SAA is that we take our SAA represents our long-term view for at least 1 year and above, in terms of where we feel like based on our 4 guiding economic principles of the year ahead at least, and then we express that how we're going to take advantage of the different opportunities in the 11 different subsectors of S&P 500 index. Where the TAA differs from the strategic asset allocation is where we look at shorter term views in terms of what are the current market opportunities and what advantages should we be taking care of. Because when we were making plans for the year ahead, at least in 2022, this was in January, and we had not anticipated for unforeseen circumstances like the Russia and Ukraine war, as well as disruptions to the global energy trade. So from there, we really wanted to sort of take advantage of shorter term positions that represent like slight deviations from our strategic asset allocation to take advantage of these opportunities so that we can deliver superior returns. But at the same time, our top consideration given the Russia and Ukraine crisis is that we might want to hold a significant portion of our assets in cash. Assets in cash. However, we did not want to hold cash entirely because of the inflationary environment and was afraid that our capital assets would be eroded. So therefore, we allocated into energy and ETP sectors.
Okay, thank you. Thanks, Ryan. So your SAA is a 1 year view, just in conclusion.
Yeah, correct.
The comment I have really is that again, it's no different from the previous groups. We don't really address the client's needs at all. For example, I think it has to come across more clearly. His preference for real estate, his preferences for sustainability, how we address it. And in this particular presentation, my comment is that it doesn't address the short-term underperformance. And I stress short-term, it's just 2 months, so no big deal. But it doesn't come across very clearly. And I also note that even when you talk all the good things about ESG, even the average ESG rating seems to be higher, i.e. worse than what's expected. So those are my comments. Yeah.
Okay, hi, MingLee team. Can you hear me?
Yep.
Okay. Okay, frankly, I actually quite enjoyed your presentation. I thought it was, if I'm the client, it's clear. You explained very clearly to me you're shifting away from growth, going to value, your reasons and all that. So I quite like that. You even gave examples, 2 examples of what you would invest in. You even talked about correlation. So, after you've picked your favorite sectors, there was a correlation. So I think that was pretty well done. Okay, I think I just have one question. You talked about liquidity that the client needs, and then you had some cash in both your SAA and TAA. I'm wondering what's your response in terms of, it's risky because when you take a portion out into cash, you may underperform the rest and my needs. So what are your comments on that?
This is in line with what Mr. Cole really wants, because I think he is mentioned in a case where he needs to make certain withdrawals depending on the scenario, and we definitely kept like $50,000 in cash, which is quite low compared to the overall portfolio, like 5% of the portfolio actually. Yeah, actually it's 5%. Yeah. So and also I think that it's very important to have a bit of cash as well to rebalance our portfolio. So like when, let's say you see an opportunity arise, you can just buy in straight away, and then you can use this spare liquidity to perform certain maneuvers, if you know what I mean. Yeah.
I think on
So we
top
try
of
to
that,
keep
we actually set a limit in terms of the maximum cash amount we wanted to hold. So understanding from Mr. Koh's distribution requirements, he needs to pay for the tuition fees for both of his children. And we wanted to keep the maximum value of at least the first year's distribution requirement amount. So what we actually observed on the ground was that because we were actually able to, I mean, sharing from my own personal experience in this competition, we were actually able to see the performances of other teams during this entire competition period. And some teams actually had a lag to start, so they did not invest exactly when the competition first started, and they were actually somewhat outperforming the S&P 500 index because the markets were mostly turning red for most of the days as well. So if I were to say would cash necessarily underperform if, let's say, it was underutilized? I would think the short answer is no, but obviously we want to be very cognizant of the fact that inflation is a very real issue, and we should ideally be deploying cash into inflation protection, protected assets like potentially real estate and commodities as well. So with both of these two factors drawing from left and right at the same time, we decided to keep the maximum amount to the first year's required distribution for his child's needs and deploy the rest into perhaps returns generating assets.
Okay, thanks for your explanation.
Thank you.
Yeah, I actually want to second I actually want to second what Connie said earlier. I think I actually quite enjoyed this presentation. I think it was a lot of concepts that was simplified for somebody who's not a professional investor. I also did like the fact that you talked about the specific stocks, why you chose them, and certain things like things that resonated with me was like I think page 11 was pretty good page where you said the objective is to reduce exposure to risk from risky sectors. I think that's what you said. So as an investor myself, as a client, I love this is what you're doing. And then you were quite clear on why you were overweighting energy, underweighting IT, etc. So I kind of like that. So just a few questions is on page 12 of 16. So why do you think, so your portfolio Sharp is minus 1.22 versus S&P's negative 0.94. So why do you think your Sharp is lower than the market? Like explain it to me in a very simple term for someone who doesn't understand Sharp ratio. And then the second question is, so your VAR is minus 23.72%. So how does that coincide with the requirement of less than 15%?
I'm sorry, could I trouble you to repeat your question because I actually can't really get it over here on our end.
Two questions on page 12 of 16, which is the Sharp ratio. So your Sharp ratio is minus 1.22 versus the market at negative 0.94. So in just very simple terms, explain to me why you think your portfolio Sharp ratio is lower than that of the market. And then the second question is in terms of the VAR, I see minus 23.72%. I thought the requirement was supposed to be minus 15%. So like how does that coincide with the requirement?
For sure, thank you so much for your comments. And I'd just like to say on a preface that like most of our viewers were expressed for the longer term, and unfortunately or unfortunately, many of the teams that participated in the competition in the first quarter of 2022 unfortunately invested in the rate market. So I think that from a realistic point of view, we could potentially expect much less desirable returns. So I guess like to start addressing your concerns, firstly on the Sharpe ratio, I think why we came slightly under the Sharpe ratio was that we, as compared to perhaps the other teams, was that we were quite confident of our long-term views. And if let's say this portfolio were to be held for at least a year, we are fairly confident that our Sharpe ratio will definitely outperform the S&P 500 index. However, why to provide a reason of why our Sharpe ratio actually came under the S&P 500 was because we didn't felt like there was a need to do very frequent rebalancing on a daily basis, and we tried to avoid as much as possible to transact a very huge transactional volume, mainly taking into consideration the very recent needs, distribution requirements that Mr. Koh has. So that's on the Sharpe ratio basis. We think that if we were able to trade for a longer period of time, we would definitely be able to at least match and outperform the S&P 500 Sharpe ratio. So in terms of the VaR, I guess like a similar rationale would hold. Like we obviously we are really trying to maintain a VaR of less than 15%. And instead, how we decided to sort of take our performance measures and recommend it to Mr. Koh was that at least we are outperforming the S&P 500 index. And if let's say we really wanted to stick to a lower VaR, we would have been holding majority of our assets in cash instead of being deployed into the safer, more value-oriented stocks. So yes, unfortunately, I have to acknowledge that our VaR did come under the constraints. But I would also like to say that the performance metrics that we are measured by might be a little bit different from what Mr. Koh is expecting, which is perhaps on a longer term basis. And currently, we're only looking at a short 1.5 to 2 months basis.
Yeah, of course, I think for me, quick short time, but maybe from a client's point of view, I mean, I just want to conclude, over here, if I'm the client, I think I may keep my 1 million in the bank right there, because if I look at the statistics over here, it makes more sense for me to put it in the banks and maybe reconsider how I can go about it. So that's my own thoughts over there. Yeah, thank you.
I'll just add some short comments. Thanks very much for the presentation. I mean, the positives of your presentation is that I think your presentation did a better discussion about the ESG framework that showed some really great slides for not just the ESG the judges it is what it is. The difficult performances, as Mr. Gay pointed out in his speech, it's the humility of that we approaches with humility. That's there are great masters in this space. So I think we have spent a bit more time explaining head on rather than waiting for the judges on the client to ask a lot of questions on it. Professional people recommendation advice that I'm sure. Thank you.
I had one point.
Just one suggestion. That's what we do, and I have great empathy for the short period of time. And the way I would probably want to address it if I were in their shoes is you look at VaR and all these things, these are all ex-post numbers, and when you analyze these numbers, they look huge. And that's the reality of things, right? Basically multiplied by 6 or something and all. The way if we have the systems that I alluded to that at the first presentation, it is to look at the XNT. We get the numbers and say, based on this portfolio, this is what the VaR will be over a period of time, rather than keep on looking back, because those are the exposed. And that's why I guess from my point of view, so I was a little bit puzzled by the word annual expected returns. I don't know where the word expected, these are realized, right? So yeah, so those are some further comments on. Yeah.
Okay, thank you for your presentation again, MingLee. We have come to the end of the Q&A segment. Judges, please have the next 5 minutes to deliver on the performance of Team MingLee. Let's give a round of applause to the first three teams. With that, we will now break for lunch. It will be a 1 hour period. So the presentation will reconvene at 1:15 p.m. later on. Thank you, everyone.
Good afternoon to all esteemed judges. We are Rawr Capital, and today we will be presenting our portfolio recommendation and performance based on our client, Mr. Cole. Mr. Cole is a 40-year-old architect currently residing in the United States. He has a wife and 2 children, one currently in college and the other pending enrollment into college next year. Based on our conversation with Mr. Cole, we believe that he has 2 key goals. Firstly, he would like to retire by the age of 45 to spend more time with his family, while also being able to provide $100,000 each to fund his children's college education. Secondly, he wishes to achieve sustained portfolio growth, on top of having long-term liquidity needs to fund his retirement. As a result, our team believes that he possesses a multi-stage investment horizon and therefore has the capability to take on a medium to high-risk appetite. Accordingly, our team has constructed 3 key themes to suit his profile needs. Firstly, we have decided to adopt an ESG long play, where we only focus on buying strongly rated ESG companies. Statistics over the past 10 years have shown that strongly rated ESG companies have outperformed the world benchmark index by an average of 2.5% per annum. And we believe that as ESG investing becomes the norm, greater returns are expected. Secondly, Mr. Cole's portfolio will be longer term based as he's still relatively young and possesses a multi-stage investment horizon. Historical data has shown that time in the market beats time in the market, with losses in inflation adjusted terms becoming negligible as the investment horizon reaches nearly 20 years. Lastly, his portfolio will be diversified across multiple sectors to ensure that sector correlated events such as the dot-com or real estate bubble will not derail his portfolio. Looking into 2022, supply chain constraints remain prevalent, with the Russia-Ukraine war making things worse. Many experts have also forecasted shipping bottlenecks to persist into 2023, with semiconductors being hit the hardest. This has led to inflation to rise at its fastest pace since the early 1980s, causing consumer sentiment to drop. Worsening of inflation has also created pressure for the Feds to hike interest rates, with many major investment banks forecasting up to 6 to 7 hikes this year, potentially impacting equities, especially growth stocks. However, the easing of COVID-19 cases and reopening of borders may be beneficial for the stock market in 2022.
And looking back at the past year, we can notice that consumer staples, utilities, and industrials lack the market. However, on the brighter side, cyclicals like energy, financials, and real estate were the best performers. Looking ahead, we believe that value and cyclical stocks are poised for a stand-up year due to rising inflation and steepening yield curve. In the short run, we foresee that stocks will remain challenged. However, we are still bullish on their long-term potential. For our SA, we analyze the 10-year historical returns and certifications in every sector. And this from the baseline of our capital market expectations. As you can see on the chart, IT had the highest 10-year returns, while energy had the lowest. We need a correlation and covariance test, which we should determine our SA allocation. For our portfolio weightage, considering the post long-term investment horizon, and these medium to high risk tolerance, 1/3 of our SA allocation was in impact stocks. As you can see from our insurance fund here, our portfolio is the optimal Sharpe ratio portfolio, with an expected annual return of 16.75% and a VIR of 9%, which is a post return requirements in risk tolerance. For our TAA, we use our SA weightage as the baseline weightage and we have a 10% deviation to take charge of the macroeconomic trends. We analyze each sector and we give it a overweight or underweight. Then we are going to incorporate our macroeconomic views on each sector. For our initial allocation in February,
We will overweight capitals and underweight tech stocks and defensive stocks. There are three key trends that shape our approach moving into March. Firstly, increasing our energy exposure due to the Russia-Ukraine war. Secondly, maintaining our exposure on IT. However, we also reduce our exposure to semiconductor stocks due to the supply chain crisis. We also offer our products to NVIDIA and AMD accordingly.
Our stock portfolio methodology utilizes 3 steps. Number 1, we analyze the ESG ratings of companies to determine ESG-friendly companies with a requirement of less than 21. Step 2, we analyze the 1-year historical returns of filtered companies by looking at the Sharpe ratio, annualized mean return, value at risk, and lastly, the standard deviation. And the third step, we consider the macroeconomic risk and outlook, and we select companies that do well relative to the sector. As a result of our methodology, we have selected 40 companies across 10 different sectors, not containing more than 5% of Mr. Koh's total portfolio. In March, we bought 2 new companies that are from the energy sector, which is ExxonMobil and Kinder Morgan. Looking at the portfolio performance, our graph indicates that we have outperformed the index constantly in the 2-month horizon timeframe, despite key macro events. Our portfolio performance can be accredited to 64% of stock winners, mainly from the financials, consumer staples, and communication services sector, all of which outperform the index. Furthermore, we believe that the energy sector will revert to the mean, boosting our overall relative returns compared to the index. Looking at the Sharpe ratio, our Sharpe ratio of 1.32 outperforms the index of 1.23 on a risk-adjusted basis. Our information ratio of 0.27 puts us at the 25th percentile of large cap stocks. And lastly, our value at risk of 6.3% is better than the index of 8.7%, indicating good risk management practices. To align with Mr. Koh's preference to invest in ESG-friendly companies, our team has conducted a strategy to invest in a rating of less than 21, which is the average of all the companies in the index. As a result, our portfolio of 14 compared to 22 puts us at the 75th percentile of the index. There was an increase of 1.14 to 1.17 from February to March. This was a result of us purchasing ExxonMobil. And the main reason for this, our rationale, is because it won't affect our portfolio significantly. Our outperformance can be accredited to our excellent risk management practices, which Ting Rong will highlight further.
So for our risk management, we evaluated our portfolio based on 3 key measures. Firstly, analyzed volatility. Our portfolio registered 23.9%, which is 35 basis points below S&P's. Next, for our correlation, is about 0.96, which shows that our portfolio is still relatively correlated to the index. Lastly, our value at risk comes in at 6.33%, putting us well within Mr. Koh's threshold of 15% and also outperforming S&P. On the right, we can see that the distribution of our portfolio's daily return is actually positively skewed, and it's well within the range of 0 to 3% with a very low frequency of negative days. Moving on to portfolio attribution, we'll be focusing on the rightmost column. So the main detractors are the consumer discretionaries, healthcare, and also energy. We failed to perform in energy because of our minimal exposure to the sector, and for consumer discretionary and healthcare, our allocations were not as large cap as those inside S&P. Therefore, on the recovery rally where the investors seek out safer assets, we failed to capture the upside as well. Lastly, for contributors, the main contributors are financials and IT, where we outperform S&P by 0.94% and 0.46% respectively. Doing a deep dive into our attribution, you can see that energy actually only started outperforming after the Russia-Ukraine war news. Therefore, we stand by our limited exposure to the sector in the long term as we analyze the historical data. It shows that it is actually registering very poor returns over the long run. As for financials, you can see that we have consistently been outperforming S&P due to good stock selection. Lastly, our decision to rebalance out of semiconductor chips companies after the Russia-Ukraine war actually proved beneficial for our IT allocation as it helped to protect against further downside. Therefore, we believe that our portfolio will outperform the S&P in the long term. Thank you for your time. Team of invest for your presentation. We'll now move on to the 14-minute long Q&A segment. Judges?
Yeah, thanks for that. Just the feedback is I quite like the presentation. I thought even just reading it prior to this, it was quite logical, step by step. And listening to you presenting it, I thought it was very smooth. I really liked how when you talked about you were choosing stocks using the 3 methods, and then you explained like each method what they are. Also, I thought the way you explained it was quite basic, which is good for somebody like Mr. Cole, who's not very sophisticated. So overall, I think it was good. So a couple of questions are, I was going through a presentation when you're making comments like, I mean, it's cyclical, it's inexpensive. You make comments on valuation. What is considered inexpensive? What is considered expensive? That's the first question. So for example, page 10 of 28.
So basically, what we did is basically to consider it being inexpensive, right? We actually look at the key ratios, and we compare it against the average ratios of the stock of the S&P 500. And as a result, we found that these certain industries, right, they have a valuation that is considered undervalued in terms of their PE, and that's how we determine our valuation approach when comparing it against sector by sectors.
Okay, so well, firstly, I think terms like valuation and expense is always a relative term. So now we say like we're basically using the S&P, anything that's cheaper than over S&P since they're inexpensive, meaning that's more expensive.
Basically, we also consider the historical trends. So actually, look at the historical PE and PE ratios of each of the sectors. Then we look at where they are trading at currently in relation to their historical averages. So if we feel like they were significantly lower than their historical averages, then we would need the sector to be undervalued and truly keep into their historical average price multiple.
Okay, so is S&P right now considered inexpensive or expensive? What's the P of S&P?
I think it's around 25 currently.
So is 25 expensive or inexpensive?
I think it's slightly above the historical averages. But there are still some sectors that are trading below their historical averages. So that was why we highlighted a few sectors over there that are currently considered cheap relative to their historical average multiple range.
I'm just only asking this because it's a relative term. Everybody can say the same thing, it's expensive or inexpensive. That's why it's just good to use a point of reference. Second question is on page 12. The chart on page 12. What's the time series? What's the x-axis?
It's basically a 10-year historical chart. And then basically we plotted out all the different sectors inside S&P. And then you can see that IT has the highest return, and then energy is the lowest over a 10-year historical time frame. So from 2012 to 2022.
Oh, sorry, I meant page 12 out of 28.
So for comparison, the chart is based on the 2-month time frame, based on the horizon. And what we are showing is basically the relative returns. So for example, the daily returns ranging from 0 all the way to -3 all the way to 4% compared to the index. That is what the chart is showing in the 2-month time frame, the x-axis.
That was useful. Yeah, just remember always the x-axis.
Maybe for me, it's also maybe on page 10 of the slides. Yeah. just want to hear from your, in terms of reducing semiconductors weightage, because all of us know that there's a shortage in terms of, the chips, etc. So why would you all reduce? Because we are seeing at least there's a demand. Just want to hear from you how would you explain this.
Okay, so from what we observed in research based on key research reports such as from McKinsey, we noticed that Russia is a large producer of key materials for semiconductors. And then since there was a trade ban on Russia, we realized that these chips will be harder to produce, and also we believe that there will be a shortage of supply, causing the entire semiconductor supply to be severely affected.
To add on to ECU's point, right? So we actually look at our specific semiconductor stocks, right? And we found that these two companies, right, they are actually facing a lot of meeting the demand issues. And the reason for that, like he said, is because they were unable to meet the demand on their end. And then there's companies like NVIDIA, right, which have really pushed back a lot of their sales in because of them being unable to meet this demand, right? And then they are not able to produce enough GPUs from their semiconductors. And as a result, they have already forecasted, potential lowering of sales in the upcoming quarter. And as a result, we believe that that is a key catalyst for us to reduce our semiconductors weightage in the short term.
Are there any other questions?
Yeah, thanks. Sure. Can you all hear me? Yeah. Can you hear me? Can you hear me? Yeah, can you all hear me? Are you all able to hear me?
Go ahead.
Okay. Okay. I'll take it that you all can hear me. I just have some very quick comments to make. My comment to the team is that I'm pretty impressed with the presentation. I found it thoughtful yet creative from a few points of view. I rather like the fact that you all had some of these what you call thematics. Whether that's the right word or not is debatable, and ESG was one of your key considerations. I'll probably add, given the client's needs and income pillar also, that's just a feedback. Again, it's aligning back to the client's interest. And the thoughtfulness I felt, which makes it more robust than what I've been hearing previously on two fronts. The way you all did the SAA, I felt was quite good. That you worked from first principles, back tested it. In your case, 10 years, it could probably be a lot more in my view, but having capital market assumptions and everything is probably the right way to start when you do an SAA, whether it be for an entire portfolio or in this case, an all-stock portfolio. And the other point in terms of being a bit more robust, the incorporation of an efficient frontier, I felt was made it a bit stronger. That you were actually thinking ahead in constructing the portfolio. So that's my feedback for the team. I'll just say well done.
Thank you. Got one more question from Ms. Connie.
Connie?
Here. So Ms. Connie has a question. She mentioned this. So I like your inclusion of efficient factor in your portfolio information. Can you explain how you constructed the different portfolio for the frontier? And your VR is very low, although your standard deviation is high. Can you explain how this was achieved?
Yeah, sure. So basically, first off, we use the S&P 500 sector weight as the basis. Then we allow for 5% deviation from each sector. And the reason is to ensure that we remain sufficiently invested in each sector without having one particular sector having a huge amount of weightage. So for example, if we So basically we use solver to solve this. And then what we did at first was not to include any constraints. So what they gave us was, for example, IT had 80% weightage, and 2 or 3 other sectors had about 5% weightage. So when we look back at the numbers, although it makes sense, but it doesn't link back to what is best for the client. So actually we added in 5% maximum deviation up and down, as you can see at the top chart over there. So basically that was the maximum and minimum allocation that we could give for each sector. And then based off this, we resolved again, and then we make some minor adjustments for each of the sectors' weights to ensure that they will still be able to align to what the client wants. Because basically, when we consider the client profile, currently he's 40 years old, and he has 5 more years to work. So basically, we foresee that for these 5 years, he won't be needing much cash installments from this portfolio because his income is still able to cover his expenses. So we believe that for the first 5 years, it would be good for him to focus on capital appreciation, and that was why we came up with a more slightly more comprehensive portfolio to have a expected new return of 16.75% annually. But then we foresee that after the 5 years will be retires, then we'll need to reevaluate our SA and move into a more defensive stance in order to support his retirement. So basically this was the whole idea behind it when we constructed the SA. I think that if you notice the main slide in our deck, right, actually the shape is not what you typically see in a textbook efficient frontier. It's more towards a C shape, and the reason is because it's not a perfect curve, and the reason is because we added in the 5% constraints to ensure that the weightage for each sector would actually make sense. So that's why the curve is slightly more towards a C shape, not a perfect rounded curve as you typically see in those textbooks. So basically that was the whole idea that we had when we were constructing the SA in order to ensure that both the numbers fit the client's requirement as well as being able to fit into our macroeconomic use for the long term. That answers the question. Okay, so the reason for the VAR outperforming the S&P 500 was basically because we over the past 2 months, right, basically the S&P 500 is very tech focused, and then for us, we managed to avoid a lot of volatile tech stocks. So that's why over our 2-month holding period, our standard deviation was lower than the S&P 500, and that in turn causes the VAR to actually be lower than the S&P's VAR, because the VAR is based off the standard deviation. So when we are less volatile than the market, our VAR will also be lower than that of the market. Yeah, so that was the main reason behind why our volatility is much lower than the S&P 500.
Hi, can you go back to slide I think it's 8 for your essay. Basically, the constructed SA, you have the slide on the 10-year historical return of the different sectors, right? So the priority was basically just to buy what has done well in the past 10 years. Is that how you construct SA?
Basically, we had to look for what combination of weightage across each of the sectors. They will give us the best risk-adjusted returns. So I think like what we have seen in the appendix, right? So basically, if we don't set any constraints.
So you just need to say yes or no. Because I just said you do that, so you also yes, you need to do that. Okay, so my current follow-up is why I'm really going to ask you this. Mr. Cole had actually 2 requirements for his portfolio. One was he favored real estate, better against inflation. Second was ESG. So in selecting the SAA, how did you include those 2 restrictions that you have for portfolio?
I think for the ESG requirement, basically was based on how we filter our stocks. So I think we mentioned that we filter out those that are less than 21. So basically above the median of the S&P 500. So that was the first one on the ESG. Yeah,
apologies, judges, participants. The time is up for Q&A segments. So judges, please have the next 5 minutes to deliberate on the performance of ARK Invest. And let's give ARK Invest another round of applause.
No, I don't like to pick up, but she felt ill. Yeah, she felt ill, so I'm helping her out. Then this is my colleague from the Singapore, which is eyeball. Yeah, correct.
Yes.
Acacia Capital, once ready, you may begin.
Hi everyone, I'm Regina from Acacia Capital. So here are my teammates, Seeking, Alicia, and Serving. So this is the no, cannot. So yeah, this is the agenda for today. Next slide. Next slide, please. Firstly, we'll briefly go through our client's profile. Mr. Koh is a 40-year-old architect with a wife who is a housewife and two children, Danny and Hannah. So while Danny is currently enrolled in a college, Hannah plans to enroll next year. So this is a breakdown of the tuition fees, cash outflows for Mr. Koh in the subsequent years to come. 5 years later, he plans to settle for early retirement and travel more with his family. Has the traveling expenses of $100,000 USD and $75,000 USD of living expenses in 2027. So this is actually also based on the expenses assumption, which are adjusted for inflation on a yearly basis. Mr. Koh has a current net worth of $10 million, an overall risk profile of high risk that focuses on equities only, and a personal preference of the following. So over the past 2 months, with a fund size of $1 million, we approximate the asset under management. As displayed in this chart here, should we be chosen to manage his total net worth of $10 million? We have assumed a 2-stage growth rate with respect to the returns. The first stage is the pre-retirement phase with 8% annual return, and the second stage is the post-retirement phase with 5% annual return. So the long-term inflation rate that we project in the US is 3.7%. So now I'll pass the time over to Celine to cover the sector analysis and our stock selections.
Okay, thank you, Regina. I will now, can I have the next slide? Thank you, Regina. I will now talk about sector analysis. We expect the energy sector to outperform due to the anticipation of rising energy prices as a result of invasion by Russia. This is because Russia is one of the top 3 energy producers in the world. The crude prices has already spiked after factoring partial sanctions on Russian crude exports. As for the financial sector, the sector tends to outperform in times of rising interest rate as banks are able to charge higher interest on loans. Insurers would also benefit as premium received can be invested at a higher rate, including the yield on their investment portfolio. So next slide. For the IT sector, as the future cash flow are discounted by a large discount factor when interest rate rises, we expect the sector to underperform. Based on the S&P 500 IT sector index, there is a decline of 14.6% in just 1 month. As the index fell sharply over a short period of time, the IT sector is likely to be oversold, providing a high likelihood of bargain purchase for long term. As for the real estate sector, the rising interest rate environment is expected to negatively impact them due to the high capital requirement associated with their operations. Regardless, the real estate sector is known to provide one of the highest yield as there is a 90% payout rule imposed on REITs. Next slide, then I will now talk about stock selection. For the energy sector, E&P subsector tends to outperform other subsectors except for equipment and services, in short, E&S sector. We choose to invest mainly in E&P rather than E&S because E&S is more vulnerable and sensitive to fluctuation in the Brent prices as compared to E&P. In E&P subsector, we choose Cordella Energy as it has the lowest ESG risk in the sector. Other than that, we also choose Occidental Petroleum as it provides a substantial dividend yield which helps to support a dividend aristocrat portfolio. For the financial sector, we choose MetLife and Low as insurance company tends to do well when the interest rate increases in the upcoming years. They also have a relatively low ESG while providing a dividend yield of 2%. Other than that, we also chose Moody, MSCI, and S&P Global because they provide a diversification effect for the cyclical nature of the financial sector, and other than that, they also have low ESG risk. Okay, so moving on to the next slide. For the IT sector, we decided to invest in companies such as NVIDIA, AMD, Enphase Energy, and Qualcomm because they are able to value add to our portfolio in the long term because of their positive industry outlook. As for the real estate sector, we decided to invest in CBRE and Prologis because of their significant lower ESG risk. We also invested in public storage, Ventas, and Coronado due to the substantial dividends they provide, which will in turn support our goal in the income generation. So I will now hand over the time to Alicia.
Thank you, Serene. So now we'll be talking about strategy and capital asset allocation. So on the left, we have a pie chart that allocates our capital for each sector based on SAA. And on the right are some of the considerations for Mr. Koh's retirement. And we propose a portfolio that is income generating and wealth preservation, because we believe that the net worth of 10 million is sufficient to sustain Mr. Koh and his wife for a retirement period of 40 years. And looking at the performance metric tables below, the expected return for SAA portfolio is generally approximately like 5% higher with a slight increase in volatility. And also the Sharpe ratio, it justifies the additional risk that we undertaken to generate higher returns. Also one more key point to look at is the 5% bar, which indicates of a lower maximum dollar amount expected to be lost over a 1 year period. So looking over at the performance metric, SAA portfolio is generally performing better and also be more profitable in the long run. Next, we are talking about the medical assets allocation. Likewise, the pie chart on the left is the allocation of the capital for each sector based on TAA. And looking at the top right table, is a comparison of SAA and TAA. So So the changes in weight for each sectors, the figures highlighted in green is an indication of overweight, and figures highlighted in red is an indication of underweight. So based on TA, we have overweight the energy, financial, information technology, and consumers discretionary sectors, and underweight the remaining. Following to the bottom table is the performance metrics. So the expected returns for TA portfolio has increased substantially, and even though that it has the highest volatility, it also offers the highest chart and information ratio. In conclusion, TA has the best performance as compared to the other two portfolios. And now I hand my time to Sikin.
Hi, thank you, Alicia. After we identified the sectors that we're interested in for our SA and TA, we analyzed the sector's historical correlation with one another to identify if proper diversification can be achieved. Based on the historical 3-year performance, the material sector appears to provide the highest level of diversification as comparison to other sectors. This remains true throughout the holding period over the last 2 months. In fact, the diversification effects of the consumer staples and energy sector also improved significantly. This is likely due to the market-wide bearish sentiment with regards to the Russia-Ukraine war, driving the prices of crude oil to more than $100 per barrel, a historically high inflation rate, as well as uncertainty as to the aggressiveness of interest rate cuts. As a result, market participants flood towards more defensive sectors, such as consumer staples and companies that produce safe haven assets, such as gold, and commodity producers, such as oil. Next. Moving on to our performance attribution, we consolidated all the S&P 500 companies' individual performance during the holding period before determining the micro attributions by sector. Our portfolio managed to generate a return of 9.64%, higher than the S&P 500. On the right, we highlighted the top 2 outperforming and underperforming sectors based on our fund allocation. As you can see, the energy sector outperforms the rest with a total value added of 7.28%. This is attributable to the positive cross-sector allocation returns, within sector returns, and interaction returns. Next. On to our micro attribution by asset, we highlighted the top and bottom 10 individual stocks that impact our portfolio performance. Based on analysis, the top 10 performing stocks is mainly in the energy sector. This includes the likes of Coterra and Occidental Petroleum. While the benchmark IT sector underperformed during this holding period, we managed to identify outliers such as NVIDIA and Enphase Energy. On the other hand, the bottom 10 underperforming stocks are mainly concentrated in the financial sector. The underperformance is attributable to us overweighting in stocks that underperform, such as MSCI and Nasdaq, as well as us underweighting in outperforming stocks, such as Berkshire.
Thank you, Acacia Capital. We have come to the end of the 10-minute presentation. We will now proceed to have a 14-minute Q&A segment. Judges, please.
Yeah, thanks for that. So a few questions for your presentation. So it sounds like you're overweight energy solely because of the Ukraine-Russia conflict. So if tomorrow, let's say, there's a ceasefire, there's no more conflict, what happens to the portfolio? What would happen to the energy sector? What is the risk you're facing to the portfolio?
Yes, with regards to this, right, the reason why we decided to overweight in the energy sector is not just mainly because of the current macroeconomic events. If you refer back to our SAA, you notice that our portfolio in SAA actually has a weightage of roughly 60% in energy. This is because the energy sectors are known to offer substantial dividend yield, as they are considered cash cows, and as such, will continue to fit in our portfolio.
Do you have a sense of how, like, you think the stocks will go up if there's a ceasefire? So the parties just become giving you the stocks as a percent. Most of them kind of grow to income generating stocks. You think it stops being down 20%?
There could be a chance, but I do not expect the prices of crude oil to fall substantially, as there has been discussions between countries to permanently avoid Russia exports in terms of crude prices. So I believe the prices of crude prices should remain elevated, at least in the short term, before any backup solutions and like whether the companies can increase their production.
Then another question is, I think you made a statement 100% the positive industry outlook on stocks like Nvidia, AMD, Qualcomm, etc. So what is this positive industry outlook?
As we know, there's a chip shortage going on around because of the previous COVID pandemic. As such, there's a high demand for chips currently. This is the positive outlook we're looking at in terms of the lasting demand for chips. This especially so with a growing need for electric vehicle companies which rely on chips as well.
Okay, but then why do you think it dropped more than other sectors? Because I think you also said tech sector was down 14.6% in 1 month. And so now it's a good time to buy. I guess the first question is, why is something down 14.6% in 1 month a good buy for the long term? Like how do you come with that statement? Why is it not should it be down 15-20%
In this case, okay, the reason why we decided to buy certain companies in the tech sector, such as those chip companies mentioned previously, there are various reasons, such as the significant decrease in price, as well as their industry position within the sector. Like let's say, for example, AMD, it has a substantially higher margin as compared to competitors. And seeing that the price of AMD actually dropped significantly to 69.81% as compared to the benchmark of 90.90%, we believe that this is a substantial decrease, which warrants a buy even if the prices continue to drop.
Okay, so the follow-up question is on page 5 of the presentation, you said it was down 14.6%. I think it was the fourth bullet point of the last. Yeah. Okay. So why does that make the buy something down 14.6%?
As we know, the tech sector, the US tech sector has been on a bull run for quite a few years now. Seeing that the index actually fell by 14.6%, which doesn't really happen that often, we believe that this is a good opportunity for us to buy in the term, buy in the dip.
Can we go back to the earlier SAA, the corporate SAA, I think slide 8 or 9. Yeah, just want to get a sense, your real estate rate is 36% in SAA.
36%.
Okay, so that is significantly off the benchmark, right? Benchmark I think is 2%. Can you just help us understand how you constructed this SAA?
Okay, with regards to SAA, we actually take into consideration the benchmark weightage of the S&P 500 as a whole. So the S&P 500 has a weightage of 27.something% in the information technology space. So
specific to me as Mr. Cole, I have 2 things I'm interested in the portfolio. One was I wanted allocation to real estate. 2 was I wanted low ESG. So I'll ask a question because the first was real estate. I asked you to arrange a portfolio that's very short S&P. Your real estate allocation you propose to me is almost 50 times larger than benchmark. So I understand why. Why is it 50 times larger than benchmark?
There's no particular reason why, because we just follow our client's desire to invest more in real estate.
I understand that. I appreciate that you overweighted it by 15 times. That's why I want to understand how you came on this chart. But notwithstanding that, when it came to practically changing it, you go to the next slide. You all also changed the weights, right? Yeah, so I also don't understand how did you end up from a 16% energy, which is significantly higher than the benchmark, which presumably should be anti-ESG, right? Which is also one of my priorities. In a tactical allocation, you decided to go to a quarter of the portfolio. So thank you very much. We made a lot of money on that on the portfolio part. Given my second priority was to reduce the overall ESG impact on the portfolio, help me understand why you doubled the allocation for TAA.
the main reason we decided to have an allocation for energy sector is actually to capitalize on the current macroeconomic effects. And then it also helps us to generate more dividend yield. So in terms of the ESG risk, right, we decided to mitigate the risk, the increase in risk as a result of us overweighting in the energy sector by going into the IT sector.
Okay,
financial sector.
so you guys have done a lot of work, thank you very much, but as a client, I need to feel that my needs were heard by you guys, so you need to bring across that you understood my needs. Okay.
You have a question from Ms. Connie. Yeah, so we have a question from Ms. Connie. So she asks, can you please explain how you consider ESG in your portfolio as required by the client? Consider ESG in your portfolio as requested by the client.
So our ESG is calculated based on weighted among the invested in each stocks, according to the ESG risk provided by the S&P 500 individual stocks. So how we aim to reduce the ESG risk is actually to invest more in lower ESG risk companies such as CBRE and Prologis, while we try to capitalize on the current macro events by investing more in the energy sector. The aim is to reduce the overall portfolio's ESG risk while still being able to capitalize on certain current events.
Okay, raise hands.
Yeah, okay. Okay.
Hi, can you all hear me from there?
Yes.
Okay, sorry, just a couple of quick comments from me and maybe a question also. The first is that I like the presentation from a few points of view, and where I find it a little bit more refreshing is that you all brought the client more or less to the front by specifying his some of his goals and everything in your, I think it's your first slide, and it was quite clearly articulated. And I like the fact that you're thinking about the clients in constructing your portfolio and your strategy. The second part I rather liked was the fact that there was specific mention of REITs, not that we should be in love with the sector or anything like that, but rather from an income point of view. I thought that was good. It sort of married some of the requirements from Mr. Koh in terms of both income as well as an allocation to real estate. So I thought that came across well for me. Where I think it fell short somewhat was, I think that my fellow judges did make mention, the ESG angle didn't come across too clearly to me. Quite honestly, I wish there was a little bit more thought in it. So those are my broad comments. I only have one question for the group. In constructing your SAA, you've got what you call expected returns. Where do you get those numbers from, that 29% and stuff like that? How do you derive those numbers? Is it from historical returns or what?
Actual return.
Actual returns. Annualized actual returns from the 2 months in the portfolio, is that right?
Sorry, can you repeat that?
Sorry?
Sorry, can you repeat that?
How did you, maybe your slide, the one under SAA, can you just move to that slide? Just so that I can point you to the right one. Okay, yeah, that we can leave it at this one. How do you get this expected returns of 28% and for your SAA portfolio and 24% for the benchmark, and expected volatility?
These are all historical data that we obtained using past 3 years historical returns of the stocks that we decided to invest in. Yeah, and basically we do our calculations based on the data.
So based on the stocks you investing in or the sector returns? It should be the sector returns, right?
Okay, we try. These are based on the stocks that we intended to invest in, like the stocks that we invest in stock sector.
Okay, and just the last one to complete this, you use 3 years, is it? Historical 3 years, is that right?
Yes.
Okay, My comment to that is probably too short, but it is what it is. Okay, thanks.
Judges, are there any further questions? Now we have come to the end of the Q&A segment. So thank you once again for your presentation. I think that the next 5 minutes will be very important.
Sorry? I miss it part. The second. It's the semi-final. Right? So India and Shanghai went through. Yeah, this is the first. Yeah. In fact, yeah, because of so yeah, used to give it through effect and certain destination, so local effect so now we find local regional. Then you really got ace out quite. Yeah, it can be quite after after 3 rounds really got ace out. It's a bit tiring. Tiring for team. The last time we went beyond the regional and I think without the real life presentation, it's also very yeah, that's right. I mean, Zoom is you really cannot see what that's very difficult to see what that's.
But I guess you have the best of Zoom presenter. The finals is also Zoom.
Yes, at this stage. So in a way, it's the best. Yeah. So it's still the best of
actual presentation.
Right, GameStop, once you're ready, you may begin.
So good afternoon, Mr. Cole. We are team GameStopped. My name is Yakun, and here together with me are my teammates Sunday and Marcus. So today we are here to present to you the portfolio we have managed for you during the past 2 months of trial period, and want to show you why we are the most suitable team that you should choose to manage your entire wealth. So first, just a quick review of your investment needs and situation. So aside from the personal details and risk and return requirements, which we have both done, I just want to highlight 2 key important things here. First is that our final portfolio should have a good exposure on the real estate as well as the ESG stocks based on your preference. And secondly, based on the information you have given to us, we have assessed your risk tolerance level to be within the mid to low range. So this means that our investment strategy will rather go with a rather safe approach and avoid having excessive risk. So before we construct our initial portfolio, we did a market analysis to make sure that our investment strategy is suitable for the current market situation. So here, let me just share with you some of the key market insights we have derived. So firstly, we have identified that there has been an intensified level of uncertainty over the equity market due to 3 key macro factors, which are persistent inflationary pressures, expectations of the Fed's monetary policy, as well as the uncertainty over the Russia and Ukraine situation. So due to the interest of time, I shall not elaborate too much details here. But with such unprecedented level of uncertainty, this has led us to eventually adopt a mean volatility approach when constructing the portfolio. Next, on the micro aspects, we have identified 2 key sector-based investment themes over the equity market. So firstly is on the supply chain disruptions and the spread of Omicron. So the insights from here is that we should limit our exposure on the sectors affected such as information and technology, while having a good exposure on sectors such as healthcare, as well as more defensive sectors such as consumer staples. Second thing we have identified would be the growth of ESG stocks, which matches well with your investment preference. So here on our portfolio constructions, we'll put an emphasis on evaluating the ESG scores of the company. So with the market insights identified as well as the investment needs in mind, here we come to our initial portfolio construction, where we have adopted a quantitative sustainable investing approach. So basically, we have utilized a combination of quantitative and discretionary methods, and our goal is to construct a portfolio that can generate competitive risk-adjusted returns with a good ESG score. So we have taken 5 steps to achieve such goal. So you can see here, firstly, we filter the stocks based on the volatility, ESG scores, as well as the annualized returns. Then after that, we move on to a discretionary approach where we pick around a group of 40 stocks with good fundamentals. And then lastly, we pass this group of 40 stocks into the last step, which is the stock allocation and optimization, where we fit a min volatility portfolio over the remaining stocks. And then we will compare the final portfolio allocation against the market insights which have identified earlier to see if it makes sense. So here I'll just elaborate a little bit more on the 4th step, which is on the discretionary filtering. So this discretionary filtering was mainly done on the industry basis, where we evaluate the companies against its peers within the same industry. So such evaluation is done in terms of 3 aspects, which are financial analysis, where we look at the current financial and valuation multiples. And secondly is on the business analysis, where we look at the annual reports and see how competitive that business is against within the industry. And lastly will be if there's any potential company specific risk attached to this stock. So after this, now I'll pass the time to my teammate Sabe, who will explain a bit more on the last step.
Right. So after the discretionary approach, we actually fit a minimum volatility portfolio of 450 figures. And we have 2 main constraints. Constraint number 1 is that we want to put at least 10% of our money into the real estate sector. so as to incorporate Mr. Poe's belief of having it as an inflation hedge. Number two is that we should at least, or at maximum, put about 15% into the IT sector, so as to, let's say, not risk too much for inflation, supply chain logistics and stuff like that. So moving on to actually how the portfolio is constructed, we see that after the minimum portfolio is constructed, we have about 30 to 40% in mainly healthcare as well as consumer staples, which are good defensive sectors and are considered an inflationary hedge. We also have about 12.5% in the real estate sector, taking into account Mr. Ko's belief about it being an inflationary hedge. We don't push too much money into IT so as to minimize the risk of Omicron or supply chain disruptions. This actually ties in very well with our market outlook earlier, and we see that actually an optimization and they basically align together. So talking about the backtest, we are actually using our allocation and testing whether how it worked for the past 1 year. We see that our portfolio is actually able to minimize risk while delivering consistently good returns. Similarly, we can see on an annualized basis on performance, if we select a subset of 50 tickers from the S&P 500 and compare those tickers to the tickers in our portfolio for the performance for, let's say, February, we see that our portfolio is actually able to perform very good returns and gives very good returns while having, if not less risk, the same amount of risk as the tickers. So now as to what happened in February, what happened on the end of February was basically we rebalanced our portfolio, the markets went volatile, and war was declared. So what we did was we basically took a three-pronged approach. We divided our portfolio into 3 different sub-portfolios. We used the low volatility portfolio, the war portfolio, and the inflation portfolio. For the low volatility portfolio, all we did was we scaled down our investment by taking down or basically closing any bad positions. For the war portfolio, we took tickers which actually benefited from soaring energy prices as well as the futures. For the finally inflationary approach, what we did was we were basically facing a relative bet on the short end of the yield curve. So we found the tickers which are most correlated with the short end of the yield curve, specifically, let's say, the 2 and 5 year yields, and went long on those basically. So what we see is we have a pretty similar allocation as previous, except that we go a little bit more on energy. So next slide. Yeah, so similarly, if we compare the analyzed performance for March compared to, let's say, a random subset of 50 tickers from the S&P 500, we see that the sweet spot is basically the top left quadrant, right? And our tickers or our portfolio, which is the green tickers, are able to achieve that as compared to a random subset. Similarly, if we do a Monte Carlo approach, we are expected to have the median wealth in 5 years, assuming that, let's say, our portfolio performs relatively about the same basis, is about 15 million. Now I'd like to pass the time to Marcus, who's going to talk about portfolio risk and attribution. Thanks.
Thanks, Amin. So now I'll go through more on the portfolio metrics as well as risk analytics and the returns attribution. On the left panel, we have plotted the cumulative wealth of the portfolio versus the benchmark. As you can see, we have yielded exceptional returns. On the bottom left is a very popular chart indicating the relationship between yield curve inversion and recession. Our main focus is to minimize risk given that we only have a long money mandate. As such, we wanted to also validate our portfolio by using a Monte Carlo simulation. The distribution, the parameters are used from the portfolio returns, and we use the mean daily returns as well as standard deviation to parameterize the cost distribution. From this, we can deduce that the median returns of our simulations are 15x, and none of our portfolio simulations actually yielded negative returns. This gives us the confidence that our portfolio is robust in the current economic conditions. On the top right panel, we have a Sharpe ratio of 3:1 and an information ratio of 1:40. Both are exceptional. Our daily VaR is a negative 1.3%. However, realistically, in the real markets, we would have a dynamic allocation to cash. This allows us to meet the constraint of 15% annual VaR. Here we plotted the correlation matrix between the different sectors, and this helps to support our bets on the thematic investments. We want to overweight on utilities, RE, and CS to hedge our long risk while having exposures to our thematic bets. On the right side of the panel, we have plotted the sector exposures for the benchmark. As you can see from the bottom right, we have a very different composition compared to the benchmark, where we focus on low volatility and high value stocks and sectors. Lastly, we'll talk about returns attribution. Typically, this is done using a model like our range. However, for our factors, we have decided to use commodity prices as well as market returns to help to analyze the effectiveness of our thematic bets. To summarize, we have a high alpha. Using a CAPM model, we have a high alpha of positive 50 points and a beta of negative 26 points. On the right, we also understand that Mr. Koh has Mr. Koh's lifestyle, risk appetite as well as his investment principles. And we aim to follow his investment principles by focusing on low risk stocks as well as low ESG score. As such, our overall portfolio ESG score is 25.2, which is a medium risk. We would like to thank everyone for listening to our presentation. We are the best in what we do, and we hope that Mr. Koh will continue to invest with us.
Thank you, Team GameStopped, for your presentation. We will now proceed with the 14-minute Q&A segment. Judges?
Yeah, thanks for that. I thought it was, well, first just some comments. I thought it was pretty good. Verbal presentation was quite good. It was very logical, like how at the very beginning kind of recap, like this is how we focus on real estate, ESG, zip portfolio we've constructed, let me explain to you how we built it. So that was pretty good. I think page 6 laid out the 5 steps constructing the portfolio. I thought the whole portfolio construction was easy to understand and was coherent. And it broke down into the 3 sub portfolios. Which I thought was also quite good and unique. I think that was quite thoughtful. And I think the fact that you focus on risk analysis, I thought that was also quite thoughtful. So I have a couple of questions. First question was on the Monte Carlo was 15x return. Like, what does that mean?
So this will be the image on the left panel, the right side. Those are the paths of the Monte Carlo distribution. What the 15x means is basically at the end of the 5 years, if you take the median terminal values of all the 1,000 portfolios, the median value is 15x returns. So with a 1 million initial investment, we have 16 million by the end of 5 years, and that's the median.
Okay, so you're saying my portfolio technically could have generated 15x over that period.
Yes, the assumption is that the distribution of returns for the 2 months is accurate compared to the annual returns. This is not true. What we aim to achieve is to check whether our portfolio returns from the 2-month distribution. If we shuffle the distribution, whether there is any chance we might have a portfolio that gives negative returns. That is the key idea. The 15x returns is overinflated and not realistic.
Okay, got it. And then just the next question is, and I also realized during your presentation you didn't talk, or you didn't mention anything about a single stock investment. Everything was at the sector level. So did you spend any time looking at these single stocks? Or any fundamentals on each single stock?
Sure. For this question, I'll pass over to you.
Yeah, so thank you for the question. So we did actually look at it on the single stock level, which we have covered in the previous slides. Here very briefly. So essentially, because actually the amount of stock we're looking at was still quite huge at this stage, we have about 80 stocks to look at. So what we mainly do is, for example, for the financial analysis, we go to the Bloomberg terminal and we look at the comparables analysis. So we look at the current financial multiples, we look at the profit margins, then we look at the we also look at the other valuation multiples such as the PE ratio. So we we will evaluate the company's fundamentals from this aspect. And then from the business analysis aspect, so essentially what we've done here is that for each stock, we went to take a brief look at the Bloomberg primers of the company or within the industry, and we to see that from the sales segment of view, relatively how is the competitiveness of this specific stock relative to its industry. So this is how we were able to sort of do the fundamentals of filtering on a faster pace basis. Yeah, I mean, of course, like ideally we will want to do like a complete analysis on these intrinsic values and conduct comparable models. But I think in the interest of time, we think that this is the most efficient and also most effective approach that we should look at.
Thank you very much for your presentation. Very balanced in terms of your charts in your presentation for the three of you. I like the use of colors. The previous presentations were all some kind of shade of blue, which is always very difficult sometimes to see because when you're looking at the ledgers. But anyway, overall, very, very good. I think you've been very clear. You've kind of the whole of whichever way you can in terms of conclusions.
And then if I were to be pedantic, then I would say you have two areas in which you need very minor mistakes. One is that you flip the ages and miscellaneous code, as well as you start to create wrong your own slides. But those are the only things that I don't like.
Yeah, I mean, for those drivers who have spoken, I agree with them fully. I mean, I like the whole balance in terms of how it was presented. I think for you also, my questions also true. I think very clear in terms of your questionings, which is I would say is very critical when you are facing clients itself. So generally, very comfortable. I like the slides. Yeah.
Can you show me the slide where you all filtered out the ESG? I think there was a slide where you showed how you filtered the 5 steps. Can you go back to that, please? Yeah. So can you share with us why the first step is to eliminate the most volatile 20% of the S&P?
The reason we went with this as the first step rather than anything else was just because our main focus was to keep the wealth he already has. Like in such a volatile environment, what you want to do is first you want to protect your investments, and then your second, let's say, agenda is to earn returns, additional returns. But your foremost priority is to not lose money for your client.
So you understand that also removes the top performing stocks as well, right?
Yeah.
Second step is, so I want good ESG stocks. So how do you understand how removing the, I think this is less than 15. What is this less than 15 number that you're
So 15 was just the data set that we were getting. ESG numbers was just the rating list.
So that's the sustainability data set you provided, which gives you a risk score. So a high risk score or low risk score, which is better?
Okay, yeah, so then higher is better, lower is better.
Sorry, I think there was a typo in this part of the slide of the question, but what we did was we eliminated the outliers from the high ESG score. And from what I know, sustainalytics is 1 to 20 is low risk, 20 to about 30 to 40 is medium risk, and high is. So
this guys did very well. Overall performance is good. Minor factors here and there. You fit the interpretation of score is fine. But when you go to your final portfolio anyway, your portfolio you only weight towards higher risk portfolio. So definitely this wasn't a typo. When you look at the final portfolio construction, your ESG risk pretty much. Yeah, which is on the above S&P, right? So you did set up and do that. But that's fine because actually these things happen because there are ESG scores that are the other way around. The other thing I wanted to go back to this 3 portfolio breakdown. Okay, so when this is your GA, so when you move into this, help me understand how are you also prioritizing my 2 focus, right? Because I wanted real estate and I wanted ESG. So how does coming into those 3 parts still maintain that focus for me?
Right. So this is where we actually balance out Mr. Koh's investment response versus achieving optimized returns. Unfortunately, to leverage on the wall, we have to focus on what prices are going up. And from the period, it was clear to see that the oil prices were the ones that were mainly driving returns. We don't have oil futures, so we only can have a proxy for it, which are oil companies, as well as utilities companies. Naturally, for these companies, their ESG scores are higher than usual, which is also why our terminal ESG portfolio rating is at 25+2. Nonetheless, we felt that we have to achieve a balance because at the point in time, not much of other thematic ideas could generate returns in the environment. But nonetheless, we also took profits within 2 weeks, just before oil prices declined, and we exited the position and held on to the rest.
Any of the judges online?
Okay, just make a couple of comments if you don't mind. Just to confirm, you all can hear me.
Yes.
Yeah, okay. I agree with my fellow judges. I think I like the way you all have approached the process. I find it more systematic, and robust. And I do like the fact that on two parts, you brought in ESG more proactively into your screening and into the process. I felt that was good. I also felt that the introduction of Monte Carlo, whilst it wasn't very well explained, is actually a good way to try to simulate and have a deeper understanding of the portfolio. So well done on those parts. My two comments, shortfalls are the following. The first is quite an obvious one, is the way you all present the performance. You analyze, I'm guessing your first slide when you say return, annualized return of 56%. No, you analyze an actual realized return, which will probably give the client a wrong impression. You probably got 4 or 5. I don't know what the actual realized return is, but if you want to present it this way, you should present the realized return. And if you want to emphasize the annualized part of it, you should put it in brackets. So otherwise, the client will go about thinking that he's got a 56% return on his portfolio in dollar terms. So that's one small feedback to you, the way you present your results. The other one that I felt was missing was the income part of it, which is again coming back to what the client wants. The obvious proxy is what's the dividend yield of the portfolio, what's the income of the portfolio. That's not represented in any of the slides, and I think that's important because that's what the client wants again. And the last part is a more technical one. If I can refer you to slide 6, and I think one of my fellow judges asked the same question, pretty much the same thing also. Whilst the methodology looks nice, I do have technical exception to screening for vol and historical vol and historical returns. What they are doing is actually to unnecessarily limit your universe for selection, because at the end of the day, the stock market looks forward, not so much backward. So if you are filtering based on annualized returns, then it is highly likely that you are going to miss out on many of the possible winners. Similarly on volatility, and I think this is shown very clearly this 1 or 2 years, right, where value has trumped over growth, and if you had just used growth and if you had just screened based on historical factors, you have missed out a lot. So that's my technical feedback to you. I don't necessarily subscribe to 1 and 3. But I think the overall thought process is a good one. So those are my comments. Thanks.
Thank you. Perhaps you can address the issue about our screening criteria. Mainly the limitation is because we don't have data. What we have is on our own, we are from a student hub. We have Schroders data up to 2020. What we wanted to do was to build a machine learning model to predict on future returns, and then use the probabilities that they will perform in the top quartile as our filter. Unfortunately, because we don't have that much data, in fact, we only have pricing data, this was kind of the most efficient way to get things started, was to actually build a portfolio. That was also why we did the second rebalancing, why we had such a sudden change in our ideologies, which is instead of having one in-more portfolio, we understand the limitations of it. We branch out to into 2 sub-portfolios, which are our thematic, inflation, and more. Regarding the real estate hedge, actually for our initial portfolio, we have about 50% allocation, which is in line with what Mr. Goh wanted. For our second rebalance, the real estate allocation was at 4%. This was also because we have shifted our allocation to thematic bets, which are not in real estate. However, our in-bond portfolio still maintains the same percentage allocation for real estate. That is why the overall it has decreased, but on a sub-portfolio basis, it has remained the same.
We have one last question from Ms. Collins. Her comment is saying that your portfolio construction was very comprehensive, even including background valuation, multiplier, and congrats. So just one question: why do you have Mr. Koh as low to medium risk when he's only 40 years old and not yet retired?
Sorry, to clarify the question, why is Mr. Koh going for? Why we justified a low to medium risk given that he's 40 years old?
Yes, that's right.
We took a balanced approach. We wanted a medium risk, not exactly a low risk. Initially, we wanted low risk, however, we realized that the performance is not really very good in the current conditions with the inflationary environment, as well as margin to pay more. That's why we decided to the second rebalancing.
Thank you, GameStopped. We have come to the end of the Q&A segment. Let's give another round of applause to GameStopped. Right, judges, please have the next 5 minutes to deliberate on GameStopp's performance. Everyone, we will now have the next 20 minutes for the judges to convene for a final round of deliberations on the performance of the various teams today. So judges, please be invited to proceed to the voting protocol for the discussion. Right, ladies and gentlemen, we will now have a 20 minutes break. So the time now is 14:39. So we will reconvene for the prize presentation segment at 3 p.m. So have a good break, everyone. After intense discussion among the judges, I have in my phone the results of the inaugural SUSS Invest and Futu SU Portfolio Management Challenge 2022. Now, I'd like to invite Dr. Tan Ju to give out the prize for the third placing. In third place, we have Momentum Capital. Thank you, Dr. Tan. Next, I'd like to invite Mr. Marvin Tan to give out the prize for the second place. In second place, we have Ark Invest.
3, 2, 1. Okay, 3, 2, 1. Okay, can.
Thank you, Mr. Narendra. Next, I'd like to invite Mr. Kevin Chia to give out the prize for the champion team. Finally, for the champion of the inaugural SUSS and Futu SG Portfolio Management Challenge, Team GameStopped.
Three, two, one. Three, two, one. Okay.
Yeah.
Next, I would now like to invite the judges to give their comments on the presentations today, as well as the reports that they have vetted today. Will any judge like to go first?
So first of all, I want to thank everyone for giving me the privilege today. I've definitely learned a lot from all of you. At the same time, I see that regardless of the outcome, they all be put in a lot of effort. So for that, I think that you should definitely be very proud of yourself, regardless of whether or not you placed it. I think as Luke said earlier, I think once you enter the real world, things will be quite different from what you're learning at school. Things are also very theoretical sometimes. You can run all these models, but at the end of the day, the outcome could be very different. So hopefully you can go home today and just remember some of the comments we gave. We try to be balanced and maybe a bit critical, but at the same time, I think once you enter the real world, it is a critical place. So people will be very direct and blunt. So hopefully today was a good learning lesson for all.
Basically, after you all read this phrase, I'm not compare everything to say anyway. So I'll keep it short. If you're a student, your goal is more or less to get a job, right? It's a party. So when you participate in this competition or any other competition, it's a test of your presentation and communication. Okay? We will of course ask you questions about the content. And this particular challenge is about portfolio management. So we'll ask you about, yes, what's the question, what's the solution, and what you did there. Right? That's only one part of this challenge. The key part is how do you communicate what you did and what's inside here out. And as we said, because it's a reflection of the real world, in the real world, there'll be people that you meet or your clients or your boss. Actually, they don't really care what's in your head or what you did. They just want to understand or trust what you said. So it's important, for example, when someone asks you a question, you listen. Why is it important to listen? It's important to listen because you do not know whether that's the real question they're asking or it's just the first part. What you'll find is common for all judges. The first question we ask isn't really the real question. It's the first part of the second question, which then is the real question. So whether it's with relationships, with your loved ones, or with your bosses, or with your job interview after this, listen, right? So that's one thing I hope that you can remember. Second thing, of course, is in your reply. like I said, I'm going to get long-winded, you're going to forget everything. So bear in mind, actually, most of the replies, if it's too long, seriously, no one's going to remember it. So keep it short. All right, 2 things only, that's it.
Maybe for me, yeah, first of all, I'd like to thank the judges, like to thank SUSS and all the committee members. I mean, everybody here also, I mean, great job done. Whether you are, you know, getting first to third or not, you are all winners. And maybe what I can say is, maybe what we like to share, or even me myself like to share is, you know, believe in yourself. You know, when you walk out of this, I mean, when your graduates have passions. And that's what you know, in Futu we always emphasize also, a lot of passion, commitment, learn more. You know, sometimes we need to get it wrong before we get it right. So what I'm trying to say is, yeah, I mean, learn more. And yeah, I mean, I got to say, it has been some time since I really stepped out of office. I mean, you know, so today is a really good opportunity. I mean, you know, to get to know each other. And of course, if there's anything later, feel free, we can mingle each other, and you know, feel free if there's any questions or anything that, you know, we can share even more, we will be more than glad. And I even have my colleagues here today. So from the corporate institutional team, from the IT side, so feel free. I mean, anything that you'd like to know. Of course, on the platform side, I think we got some feedbacks. Surely on our side, we will do more, and we will enhance it even further. I mean, we're just here for slightly more than a year. So many things to come, many changes to come, and that will improve your investment journey. Yeah, thank you guys. Thank you everybody.
So thank you everyone for this privilege to be a judge today. And all I can say, to keep it short and sharp, is that it's a privilege to serve on this panel of judges, 2 of whom are online. You know, listen closely to their messages, because they speak from their heart, they speak from their experiences, which is not common in panels that I serve. So I think today we, you know, have wonderful fellowship with one another. And, you know, you're very lucky to get these comments, and you'll figure it out, you know, along your careers, that you start to resonate some of these points in your career. So good luck to all of you, and hope to see you again. Take care.
I'd just like to check with the guests as well, maybe the advisory council, would any of you like to provide any comments for the conversation today?
Hi. Thanks a lot for all the hard work we put in. You already did a really good job. It's been a long and grueling experience. I also like to take this opportunity to thank all the nice judges for volunteering their time to give us the, as well as the organizing committee who also did a lot of work behind the scenes. Thank you.
Ladies and gentlemen, with that, we have come to the end of the Portfolio Management Challenge. So thank you for your participation in this challenge. We hope to see you again in next year's SUSS and Futu SG Portfolio Management Competition 2023. Thank you everyone, and have a good weekend ahead.